Welcome to Acera's new employee slash mid-career seminar. In this seminar, we are assuming that you're either new or you're somewhere in the middle of your career, hence the name of the seminar. So you're not in your retirement yet is the bottom line, and that's a good thing because it means you still have plenty of time to plan for retirement. So in this seminar, I'm going to tell you all the things that you might want to know about doing that planning. And since you're curious enough about retirement planning to watch this, you probably have some questions. Questions like, what do I need to know about my pension? What do I need to do? Do I need to do anything? If I need to do something, what is it? Well, we're going to answer all of those questions in detail. In fact, I have organized the presentation in the form of this checklist, and we're going to go through all of these different topics today. So I'm going to help you understand, excuse me, understand some retirement basics. And as part of that, we're going to transition into a discussion of a little bit of pension math. Okay, it's not very much, it's one equation, which is our retirement formula. And the reason I'm going to tell you about that, even though you're nowhere near retirement, the reason I'm going to tell you how we will calculate your retirement when it comes time is because there are a number of details in there that will help you understand how you're earning credit toward retirement and how to maximize your retirement in the categories where you're earning credit toward retirement in the retirement formula. That's something that is good to know right from the beginning. If you know it from the beginning, it helps you plan for the future more effectively. So that's why we're going to do an orientation on that. And I'll also talk about purchasing service credit during that time. Service credit is one of the components of the formula. Okay, then I'm going to help you get a pension estimate. So I'm going to show you how to do that, how to take a little peek into the future to see what your future retirement benefit might be, what you can expect. And I'm also going to help you understand retirement eligibility. So this is when you actually become eligible in the future to retire, to stop working and retire and start collecting your pension. Excuse me. We'll also talk about some additional benefits like healthcare benefits and death benefits, and a little bit on disability benefits. I will talk to you about designating your beneficiaries with Acera for death benefits. And I will help you understand career planning options. And what I mean by that is at some point in the future, you're going to stop working in your job. And so what will your next steps, what are your options regarding your membership with Acera and your pension at that time? Additionally, I will talk about making a retirement planning picture. And so what I mean by that is, what will your income look like in retirement? What will the sources of your income in retirement be? And what tools can I give you to not only take a little peek into the future to see how much your retirement might be, but to then tweak the present so that by the time you get to retirement, you will have a comfortable retirement. And as part of that, we'll talk about starting a 457B account. And that is when I'm going to turn it over to the 457B expert who's going to join us at 11:15. We'll talk briefly about signing up for Acera News as well. Okay, so let's jump right in. First of all, understanding retirement basics. So starting at the beginning, who is Acera? Well, in one sense, Acera is this acronym, Alameda County Employees Retirement Association. But Acera is made up of a lot of people. So there are about 90 of us that work here, 90 plus. And our entire job is to provide retirement, disability, and death benefits to all of our members. Our members are you. You are members. So you are also part of Acera. You all are also part of the who that is Acera. And you are a member because of the position that you work in and who you work for. So you work currently, or at some point in the past, you worked full-time, and that was in, or is currently in, a full-time retirement eligible position for one of the 6 employers that participates in Acera. These are the 6 county agencies in Alameda County that use Acera to provide retirement benefits to their employees. We have Alameda County, Alameda Health System, Superior Court of California, First Five Housing Authority, and Livermore Area Recreation and Parks District. So if you work for one of these agencies and you worked full-time in that retirement eligible position, you automatically became an Acera member. You didn't have to do anything. It was just automatic. And as an Acera member, what you do is with each paycheck, a little portion of your paycheck comes out and it goes into Acera's fund. I have an illustration of that on the next slide. This is a screenshot of a county pay stub. And the before tax deductions column is zoomed in on here. And you can see that there's a line that says retirement. And there's a little bit of money coming out of your check going into Acera's fund. And you can verify your Acera membership by looking at your pay stub and making sure that that is occurring. So every time you get paid, you're contributing to Acera's fund, which means that you are deferring some of your payment now for later. So you're paying for this retirement that you're earning. Additionally, one of the benefits that's provided to you as a government worker is your employer makes a contribution to Acera's fund on your behalf. So you're contributing to the fund, your employer is contributing to the fund, but we don't want that money to just sit there and collect dust and lose money to interest. So we invest it all over the world, and we actually earn quite a bit of interest on our investments because we have a widely diverse portfolio. And it's these three sources of income that make up Acera's fund. The employee contributions, your employer contributions, and your investment earnings. And you cannot change the amount of your contributions. They're set by our actuary, and they're determined by how much Acera needs to pay what it owes. So we know our actuary tells us how much we owe now and in the future, and then they set the contribution rates based on how much we owe now and in the future. And so your contribution rate is whatever your contribution rate is going to be. And it can fluctuate a little bit from year to year. And to answer your question, there is no typical amount that comes out of the paycheck. It's different for everyone. And if you want more information on your contribution rate, there's a web address down here, acera.org/contributions. And you can find your exact contribution rate, or you can just see what the average that everyone's paying for your tier. And we'll talk about tiers in about 3 minutes. Okay, so more info about how Acera works. So this money that we're collecting for Acera's fund, what do we do with it? Why are we collecting it? Well, we're collecting it because while you work, you are earning credit toward retirement. You're earning your pension, okay? With each hour that you work, you're earning your pension. And at some point in the future, the reason that you're paying in is because at some point you're going to retire, and then you're going to stop earning your retirement, and you're going to start collecting on the retirement that you've earned in the form of a monthly retirement allowance that will come on the last business day of the month, every month for the rest of your life. It is a secure retirement that you can count on every month for the rest of your life. It's amazing. It means that you, leading up to that, can do an estimate of what to expect in retirement so you can plan effectively for retirement, and then you can expect to receive that retirement allowance every month for the rest of your life. So it's an amazing thing. And in fact, pensions are special. Acera is known as a defined benefit pension plan because your benefit, and I'll throw this terminology around. It all means the same thing. Your benefit, your pension benefit, your pension, your retirement allowance, your retirement benefit, all these things mean that same thing, that monthly retirement payment that you're going to receive every month for the rest of your life. It's a very special thing. And let me just give you an example of why that is. When you go to retire, everything you paid into Acera throughout your entire career, plus the interest that we have paid on to your account, because we pay interest twice a year, you're going to get all that money back as soon as you retire within the first 3 to 5 years through those monthly retirement payments. And then everything after that it's almost like this amazing bonus that you get, because you get all your contributions back. Plus, then you get a secure payment every month for the rest of your life that will never stop until your death. And the reason that we're able to do that is it's partially from the employer contributions, but mostly the investment earnings. They pay about 75% of your lifetime retirement. So part of the specialness of participating in a pension is the fact that you're pooling your deferred wages with all of the other 10,000 active members who are participating in ACERA, and they're professionally invested. So you get the synergy of that. We get access to a lot of investments that individual investors don't get access to. So that's a little bit of why pensions are special. And mostly it's about that secure payment for the rest of your life. So yeah, just to reiterate, there's a question. Everything that you paid in the system will be returned to you within that first 3 to 5 years through your pension payment. And everything after that, then it starts getting paid out of the employer contributions. And then when those run out, it gets paid out of the investment earnings. But you don't really have to worry about that. The only thing that you should be focused on is how much your pension is. And I'll talk about how we calculate that and help you get an estimate of that. And yes, it is a lifetime benefit every month for the rest of your life. You cannot outlive your ACERA retirement. Okay, let me show you some pension milestones here. This will help illustrate some of the concepts that we're about to talk about. The first milestone is your date of hire, also known as your first day of work in your full-time retirement eligible position. Sometimes you get hired directly into that full-time retirement eligible position. Sometimes you were working in some other capacity for your employer. Maybe you were working as a temporary employee or as part-time. And so what I mean by date of hire is the first day in that full-time retirement eligible position. Okay, then what happens is the next milestone is 2 weeks passes, and the first day of your second pay period, that is your first day of ACERA membership. That is also known as your date of ACERA entry or your date of entry into ACERA. This is when you start earning the credit toward retirement. And this is when you start paying into the retirement system. Now, there's 2 of our employers at Livermore Area Recreation and Parks District and Housing Authority, where actually these 2 dates are the same. Your date of hire and your date of entry started on your first day in that retirement eligible position. Okay. What happens then is 5 years goes by. And when you reach 5 years, you're considered vested in the retirement system. And vested, it just basically means guaranteed. So when you reach the vesting requirement for the benefits, you're guaranteed the guaranteed benefits. Basically, you're guaranteed the vested benefits. That's all that means. It's not real complicated. Okay. Then after that 5 years, at some point in the future, and it's going to be different for everyone, through some combination of years that you've worked, years of service credit, and your age, you will reach retirement eligibility. And I'll show you what those requirements are in detail later on in the presentation. But once you reach retirement eligibility, this is the first day that you could actually retire if you choose. Or you could choose to keep working and keep earning more and more credit toward retirement. Which is why for most people, there's going to be a gap here. You reach retirement eligibility, you keep earning credit toward retirement, and then the next milestone is your retirement date. This is a date in the future that you choose when you say, I'm ready to stop earning retirement and I'm ready to start collecting the retirement that I've earned. You're going to collect that retirement that you earned every month for the rest of your life, like I said. So between here, your retirement date and your death is when you're collecting your retirement, and that's when your retirement payments stop. And there's another milestone on here, you'll see, which is for at the time of retirement, you're going to get 5 options to choose for your beneficiaries. And most of the options will provide a continuing payment every month for the rest of your beneficiary's life. And this is what's known as a continuance. And so there could be, depending on your option and your situation, a continuing payment to a beneficiary every month for the rest of their life, and at which point at their death the continuance payments would stop. Okay, so those are your pension milestones. Just another quick word about vesting. Like I said, it happens at 5 years. Okay, So when you achieve 5 years of service credit, means you worked 5 years full-time or the equivalent of 5 full-time years. You are considered vested in the system, and you're guaranteed the guaranteed benefits. And the guarantee comes from state law. Okay. So the state law governs how the retirement system works. And there's a little line here that says including reciprocity. We'll go into reciprocity in the second half of the presentation, but just so you know, for those of you who have it, which is where different retirement systems are linked together, 5 years across all of the linked together retirement systems will get you across that 5-year vesting requirement. Sorry about that. Let me go back. And the vested benefits are that monthly retirement allowance every month for the rest of your life, an annual cost of living adjustment, which is a percentage increase to that retirement allowance every year on April 1st, and also a $1,000 lump sum death benefit, which is like a basic kind of burial benefit. But there are other death benefits, like I was telling you a minute ago, that will come with the different retirement options. But this, I just like to point out that this $1,000 death benefit is considered vested. We will talk about, I see a question up there, we will talk about buying back years of service credit. So we will go into that. We'll get to that when we talk about service credit. Okay. And a copy of the slideshow is actually already available. Let me show you where that is at. Let me just bring up the website here real fast. Sorry, I didn't have it open. I should have prepared. So you go to our website, you go under news and events, go down to retirement planning seminars. That's where you may have signed up for the seminar here, or you may have done it through the email that we send out. And you just go under webinar options, new employee mid-career webinar, and there it is right there. New employee mid-career seminar presentation handout. Okay, so going back to the presentation, let me make sure I covered everything on the previous slide. Yes. Let me tell you about your tier. You all have a tier. You all are in one of these tiers, okay? And your tier is based on your date of entry into ACERA. So this is, remember, your first day of ACERA membership. For most people, the first day of your second pay period, except for LARPD and Housing Authority, where it's your date of hire. Now, to start off with, let me define some terms here. Safety members are sheriff's deputies and probation officers, and there may be some other sworn officers in there that I'm not aware of. Those are safety members. Now, if you're a safety member, you know it. If you're not a safety member, that means you're a general member. So that's everyone else as a general member. So if you're a safety member, you look at the bottom timeline. If you're a general member, you look at the top timeline, unless you are a general member working for the Housing Authority or Livermore Area Recreation and Parks District, and then you would look at the general member timeline for your employer. So the way this works is, if your date of entry into ACERA, your first day of ACERA membership, falls before the cutoff for the tier, that puts you in the earlier tier. So for example, and there's probably no tier 1 members watching this because there's hardly any tier 1 members left since it it closed so long ago, and they've all retired by now mostly. But if you started work before July, if you started work, before July 1st, 1983, that would put you in tier 1 as a general member. If you started work, and what I mean is started work is entered ACERA, July 1st, 1983, all the way up to December 31st, 2012, that puts you in tier 2. If you entered ACERA January 1st, 2013 and beyond, that puts you in tier 4. And that is true for all of the timelines for tier 4. Now, for safety members, you see there's a few more tier 2s with some different cutoff dates. For tier 2C and tier 2D, you entered ACERA October 17th, 2010, all the way up to December 31st, 2012, and you had the choice between the two tiers that you made within 45 days of achieving your safety membership. For the Housing Authority and Livermore Area Recreation and Parks District, you can see that LARPD has a tier 3 that nobody else has, and there's a different cutoff. And for housing authorities, there's a different cutoff for tier 2. So there may actually be some housing authority tier 1 members still around because the cutoff date wasn't that long ago. So you may not have retired yet. So this is an explanation of why you're in the tier that you're in. If you don't remember your date of entry, all you need to do is log into your account on our website. Let me show you how to do that real fast. Going back to the website. From any page on our website, you just go up to the login button, and that takes you to our member portal known as Web Member Services, and you just log into your account, and there's all your pension data, including it will tell you your date of entry, and it will even tell you your tier, so you can verify that you're in the correct tier. And if you've never gone in here, you will have to create an account. So you just click the sign up link, and you'll answer some security questions before you can actually create the account. But once you get in there, you'll find that your pension data is in there waiting for you because it connects with our pension database software. Okay, so those are the tiers. And people ask why there's different tiers, what the differences are. The way that we calculate your retirement allowance is going to be slightly different among the different tiers. So there's different rules around the different tiers, and we'll get into that during the presentation. You'll see what some of the differences are, but it's good to know what tier you're in during the presentation while we go through, so you can see which rules apply to you. Okay, so I'm going to show you the slide right now to just give you some context for our broader discussion. I'm going to revisit this slide later on in the presentation when we talk about retirement planning options and methods of retirement planning. But I wanted to give you some context right now for the discussion. So when you go to retire, financial planners, one of their general rules of that industry is they will tell you that in order to maintain your standard of living that you're enjoying before retirement, you will need to have 70 to 80% of the income that you were receiving just prior to retirement while you were working. You're going to need 70 to 80% of that as income in retirement to maintain your standard of living. Okay. And so when you retire, you're going to have various sources of income. One of those is going to be your Acera monthly pension that we're going to talk about quite a lot during this presentation. Another source of income, if you're paying into the Social Security system, you will be able to receive Social Security payments out of that system when you become eligible for that. Anything beyond that, and perhaps you have another pension from another public employer, so you could add that in here too, kind of under the heading of pensions in general. Anything beyond those two is going to be your personal savings and investments, okay? Now, this might sound a little nerve-wracking at this point, especially if you're brand new in your career. But what I'm gonna talk about your Acera monthly pension, and first of all, you're gonna see how powerful it is. And second of all, when we get to the part about savings and investments, because this is kind of gonna make up the gap that the pension and the Social Security doesn't quite get you up to in some cases. In some cases, it'll do the whole thing. It'll get you the whole way, the pension and Social Security. But in other cases, you may need to save a little bit more. I'm going to show you a tool that makes it super easy to figure out how much to save, and we'll talk about where to save. That'll make it super easy, and you'll see that it's actually not that complicated. You all are very good at the complicated nature of your public employment. And so I think you'll find that this will actually be a little bit of a breeze compared to the complicated tasks that you perform in your job. Okay, so what I'm going to do is talk a lot about the monthly pension, then we'll circle back to this slide and go into the Social Security and savings. So let's talk more about the pension. We'll talk about understanding pension math. Some of you have an allergy to math. Don't worry, this is the only math that we're going to do, and it's just a multiplication, okay? Simple multiplication. This is how the pension system works. And the reason I'm explaining this to you and going into a little bit of detail, even if you're brand new, you might be wondering, well, why do I need to know this right now? The reason is because that concept that I was saying earlier, where you're earning credit, you're earning your pension in certain categories, you're earning credit toward your pension in certain categories. These are the three categories where you are earning credit toward your retirement. You're earning credit in this age factor percentage simply based on getting older. You're earning credit in the service credit category by working more years. You're earning credit in the salary category by earning whatever salary you earn, and over time, you probably earn higher and higher salaries. And so when we multiply these three factors together, the higher and higher each of these three things are, gives you a higher retirement allowance. So I like to describe how we arrive at these numbers so that you know how to maximize these right from the beginning. And it's not a mystery about how to maximize your retirement in the future. Okay, so let's dig into this equation a little bit. When you go to retire, at the time of your retirement, we're going to do this calculation. The math equation is exactly this. We're going to do this for you, okay? And what this equation means is that in your retirement, in your future retirement, you will receive as your retirement payment a percentage of your highest salary that you earned anywhere in your career for each year of service that you worked during your career, okay? You get a percentage of your salary for each one of those years of service that you worked. Let me give you an example, and it will help illustrate this concept a little bit better, okay? So let's say that the percentage of your highest salary that you're going to get for each year of service is 2%, just to give you an example. And let's also say that you work for 20 full-time years, or the equivalent of 20 full-time years, which means that you earned 20 years of service credit during your career. Well, your retirement allowance is going to be 2% of your highest salary for each individual one of those 20 years. That means that we're basically multiplying the 2% times the 20 years to figure out what percent of your salary you're going to get, which in this case is 40%, because 2% times 20 years is 40%. 2% for each one of the 20 years is 40%, okay? You're going to get 40% of your highest average monthly salary. That's your retirement allowance. Now let's continue the example. Let's throw another number in here. Let's say your working retirement, let's say your working salary in the years leading up to your retirement is $5,000 per month. So you're going to get, as your retirement allowance, 40% of that working salary. 40% of $5,000, when we multiply them together, is $2,000. That becomes your retirement allowance for life. And then you'll get the cost of living increases every year to that retirement allowance. But this is what you start off with, okay? And that's how it works. See, it's pretty basic. Now, the bottom line here, for again, just to reiterate this point, for each one of these categories, each one of these factors in the formula, is that the larger each one of the numbers is, because it's a multiplication, the larger the age factor percentage, the larger the service credit, the larger the higher average monthly salary at the time of your retirement that we do this calculation, that means a higher monthly retirement allowance. So in order to maximize your retirement allowance, you maximize each one of these numbers. Well, how do you do that? Well, let me show you how we calculate each one of these numbers individually, and that will help you understand how to maximize them. Okay, so starting off, we'll do the age factor percentage first, okay? Okay, and I see a lot of questions popping up that you're about to get the answers to, but my colleague is also going to type out the answers for you. Okay, so let's start out with the age factor percentage. How do we arrive at which age factor percentage we're going to use in the formula for you? Because it's not necessarily going to be 2%. It's going to be a percentage based on your tier and your situation. So what is that percentage going to be for you? What percentage of your highest salary will you receive for each year of your service? Okay, so first of all, here's an example of our age factor chart that we'll use to determine which percentage. And you're going to find your tier on here. So if you're a safety member, you look at your tier over on this side. If you're a general member, you look at your tier over on this side. And again, safety members are sheriff's deputies and probation officers. General members are everyone else working for all of our employers. Okay, so just look at the column for your tier and forget about all the other columns. The way this works is, let's take tier 4 general member, for example. Okay, if you're a tier 4 general member, let's say that you retire at age 65. Okay, so what we're going to do at Acera is we're going to come over to the chart. We're going to come down to age 65. We're going to go over to general tier 4 and we see 2.30%. That is the percentage we're going to use for you in the retirement formula. That's your age factor percentage based on your age at retirement. Now, you'll probably notice a few things about the chart. One is that the percentages get larger the older you are when you retire. So the longer you wait to retire, the older you are, the higher the age factor percentage you will get in the formula for you. So that's one way that you're earning credit toward retirement, is simply by getting older, by getting larger and larger age factor percentages. The longer you wait to retire, the older you are. You'll also perhaps notice that there is a maximum age factor percentage for each tier, and that is denoted by the blue box. So you'll see that, for example, general tier 2 members, the maximum age factor percentage is 2.43%. And that happens at age 65. If you retire at age 65, you would get the 2.43% age factor percentage in the formula. If you retired older than that, you would still get the maximum. If you retired at 66 or 67 or 77, you would still get the 2.43%. And the same goes with all of the other tiers. For tier 4, it maxes out a little bit higher at 2.50%, but you got to wait 2 more years and retire at age 67. So that's the trade-off for tier 4. You may also notice that I skipped a bunch of the ages. I'm not showing you all the ages. And that's because there's actually way too many incremental age factor increases to fit on the slide, because they actually increase every quarter year that you get older and don't retire. So if this were the full chart, it would say like 52, 52 and a quarter, 52 and a half, 52 and 3/4, 53, 53 and a quarter, 53 and a half, and so on and so forth. And every quarter year, there's a slightly higher age factor percentage that you would receive in the formula for you. And the quarter years are based not on the fiscal year, not on the calendar year, but on your birth date. So for example, if your birth date is January 15th, you move ahead 3 months, go to the same date, April 15th, that's the next quarter year. You pass that date, you go up 1 notch in the age factor chart. July 15th, you go up another notch. September 15th, is that right? No, October 15th. You go up another notch in the chart and back to January 15th. So every time you pass one of those quarter years based on your birth date, you get a slightly higher age factor percentage. If you want to see all of the age factors, go out to our website, acera.org/age, and it shows you the entire chart of all of the age factor incremental increases. Okay, so that's how the age factor percentages work. Now, that's a lot of information to throw at. Some of you are in your mid-career, some of you are new employees. If you don't want to remember all the details because you don't actually really need to know them at this point in your career, one thing that you can remember, one thing that you can take away from this, the bottom line here is that an older retirement age equals a higher age factor percentage. So you can just remember that. And then if you remember that, you can come back later and refresh yourself on what the percentages actually are. And again, that's up to the maximum for your tier. Okay, let's see if there's any simple questions here. There is one question. Why is tier 4 better than tier 2 at age 67? Well, tier 4 was created by the state legislature in 2012. It started on January 1st, 2013. It was created as a pension reform, and I'm doing air quotes. That's what they called it, a package, basically to kind of standardize all of the county pension systems across the state. And they're the ones that created this set of age factors for tier 4. And so I think the trade-off for tier 4 over tier 2 is that, yes, there's a little bit higher age factor percentage, but you got to work for 2 more years and retire at 2 years older. So if you did retire at age 65, your age factor percentage would actually be lower than tier 2. So that's one of the trade-offs for tier 4. But it's not, it doesn't actually, I'm not sure that it's a healthy exercise to compare the different tier, your tier with somebody else's tier, because you can't really control what tier you're in. It's just based on when you entered Acera. So the percentages are what they're going to be, and they're never going to change. So, they are what they are. This is going to be your set of age factors. But just to satisfy your curiosity, that's why that is. Oh, I see there's a question. Can attendees get a copy of the Q&A that was answered in the chat? Yeah, Zoom will let me export the Q&A, so I'll see if I can figure out how to email that out to everyone after the webinar is over. Thanks, that's a good idea. Okay, and then there's another person who was asking about the difference between tier 2 and tier 4. Plus, there's a follow-up. What happens if you leave your position before you retire? We have a whole section on that in the second half of the presentation, what your options are if you leave your position but don't immediately retire. And just to give you some terminology for that, because I will refer to that during a few different times in the presentation. While you're actively working in your Acera eligible position and you're paying into the system and earning service credit, we call you an active member. When you retire, we call you a retired member. But there's an in-between category where you stop working but don't retire immediately. You defer your retirement to a later date, and then in that case, we call you a deferred member. And you're still an Acera member, but your membership is just kind of on hold. And we'll go into the different caveats of deferred membership and what your options are should you want to do that. Okay, we'll go into all of those. And yes, the video presentation is being being recorded, and we will provide it out on the website within the next week, because it takes us a little bit to edit it and get it up on YouTube, video rendering and all that, and uploading. But having said that, if you wanted to review this webinar immediately afterwards, we tape all of them. So we have, all the previous ones out on the website already. So you could always refer to an earlier presentation. Okay, so I talked about the age factor percentage. Let me tell you about the service credit. And I got a lot of details for you about earning service credit and purchasing service credit. So to give you a visual representation of earning service credit, we go back to the pension milestone chart. You start earning service credit toward retirement when you become a member of Acera. So, and I see there's a question about Acera medical plans. We'll touch on that briefly toward the end of the presentation, the medical benefits. Okay, so you start earning service credit when you become a member of Acera. So this is your on your Acera date of entry. So that's the first day of your second pay period with Acera in most cases. And as soon as you become an Acera member, as soon as you start working, you earn your first service credit within the first 15 minutes. Okay, so we are keeping track of your service credit down to 15-minute increments. You will earn service credit during your entire career, all the way up. If you go directly into retirement, then you will earn service credit all the way up until you go into retirement. And that's when you stop earning service credit, you stop earning credit toward retirement, and you start collecting your retirement. Now, for some of you, you may leave your work and not retire immediately, which is what I was just talking about, becoming a deferred member. In that case, there would be an additional milestone for you here. I should actually edit this milestone chart to make this point visually. There would be a termination date on here, and that is actually when you would stop earning service credit. So you just earn service credit while you work. So during your regular working hours, you're earning service credit. Also, you're earning service credit on your earned leave times listed out here: vacation leave, sick leave, management leave, comp time, holidays, floating holidays. You're earning service credit during all of those leave times. Those do not count against you for the purposes of earning service credit toward retirement. Okay, now, because we have a list of times when you are earning service credit, there's also a list of times when you do not earn service credit. You don't earn service credit during leave without pay. Anytime you're on leave without pay, you're not earning service credit. Also, if you purchase additional vacation, which some of our employers will let you do on top of your earned vacation. So it's like you earn 3 weeks a year and you purchase an additional week, is an option some of our employers let you do. When you take that purchased vacation, you do not earn service credit during that time. So whenever you mark purchased vacation on your timesheet to use up that vacation that you purchased, you're not earning service credit during that time. Okay. But having said that, it's not a big deal, actually, because if you purchase a week of vacation here and there, like in the span of your entire career, with the years of service credit that you're going to be earning, missing out on a week of vacation here, a week of service credit here or there from a purchased vacation is not gonna make a big deal. It's gonna affect your retirement, maybe a few pennies. So don't stress out about that. Okay, additionally, sold vacation. Another option some people have is to, when you earn your vacation, your employer will let you sell it back to them for cash. So they'll put additional money in your check and you don't take the vacation. If you do that, you don't get service credit for that vacation that you sold. Now, if you sell the vacation toward the end of your career, during the time where we're going to use to calculate your salary, and I'll touch on this briefly when I talk about the salary component of the formula. You may get salary credit for that, but you don't even worry about that concept now as a new employee or in your mid-career. That's something to learn when you're preparing for retirement in the 3 years before retirement. Okay, so you also do not earn service credit for overtime, on-call time, or standby time. Okay, now, because if you recall from the retirement formula, the higher those numbers are, including service credit, the more service credit you have, the higher your retirement is going to be, meaning you've earned more credit toward retirement. There are some types of time that are eligible for you to purchase that will increase the amount of service credit we put in the formula for you, and that will increase your retirement allowance. And this is a really good concept to understand as a new employee or in your mid-career, because it's a really good idea to purchase service credit as soon as you incur one of these types of time, or as soon as you can afford to purchase the service credit. So let me give you a whole bunch of details about purchasing service credit. Okay. First of all, the overarching theme here with these types of time that are purchasable is that if the circumstances were slightly different, you could have earned service credit for that time. But the circumstances being what they were, you were ineligible to earn service credit for that time. Though, basically the law doesn't let you allow you to earn service credit for that time, but they will then let you purchase that time later. Okay. So here are the categories of time that is purchasable. The first category is known as ineligible or non-covered service purchase, because it's this time that was ineligible for earning service credit, but then you can purchase it later. Okay, and that includes part-time work, where you were just working part-time for your employer before you achieve your full-time retirement eligible position. And I'm not talking about working for a temporary agency or an employment agency. I'm not talking about working under contract. This is just plain old part-time, or you're working for your employer. That you did not earn service credit for that time. But then once you achieve your full-time retirement eligible position and automatically became an SERA member, then that part-time work becomes purchasable. Okay, next category is TAP time. That's an acronym for the county's temporary assignment pool, which is the county's internal temp agency. Now that time actually is purchasable. All of that time is purchasable once you become a full-time retirement eligible employee. Okay, there are some other categories for some other types of time you may have worked before your full-time retirement eligible employment, including seasonal work, intermittent work, service as needed work, project work, per diem work. There's perhaps some other names for these. Those are purchased. That time is purchasable. Okay, so and just so you know, I'm going to tell you, I'm going to have a couple of slides in just a minute on how much it's going to cost to make the service credit purchase, how you initiate figuring out how much it's going to cost to make the service credit purchase, how you actually make the purchase, how you figure out whether it's worth it. I'm going to talk about all that. Okay. Next category of service credit purchase is the days between the hire and entry date. So that 2 weeks, that's purchasable. 2 weeks, it's not going to make a huge impact on your service credit amount, but feel free to ask us how much it's going to cost, and feel free, when I tell you how to do it, to run the estimates to figure out what impact it will have on your future retirement allowance. And you can decide whether you want to make buy that 2 weeks. Some people just like to buy up all the time. That is, possible to buy up to maximize that service credit number. Okay, next category, unpaid medical leave. This is where you go out on unpaid medical leave, and when you return from the unpaid medical leave, then you can purchase that time up to a year per instance. Often, I think what happens is you go out, you get sick, you go out on leave, and you burn through your sick leave and your vacation leave, and then you're just out on unpaid medical leave. Okay, so then once you're on the unpaid medical leave, that time becomes purchasable once you return from it. And it's 1 year per instance. So if you're out on unpaid medical leave for a year, you come back, then you go out on unpaid medical leave again for another year, come back, both of those 1 year periods would be purchasable. Now, if you go out for a year and a half and come back, just 1 year's worth of that year and a half would be purchasable. Okay, state disability insurance leave, similarly, once you return from the state disability insurance leave, then that time is purchasable. Additionally, sometimes the way that works is you are out maybe on workers' comp, and you're being paid from the state through the workers' comp system or the state disability insurance system. I'm not sure what the difference is between those two. They may be the same system. But the bottom line here is that you might be paid partially by your employer. You might actually be receiving a partial paycheck for part of your normal work time, and then you're also being paid by the state disability insurance system. The time where you're receiving the paycheck, you're actually already earning service credit, and the other portion of it, the state disability insurance time, that partial time would become purchasable. And I see that there's a question, is there a deadline when you can buy back the service credit? And the deadline is you got to do it before you retire. That's the only deadline for that. Now, I will show you that the longer you wait, the more expensive it gets. So it's a good idea to purchase it as soon as you can. And I'll show you why that is in just a minute when we talk about the costs. Okay, now military leave during membership, you can buy that back when you return. And just to be clear, this is where you're in active status with your employer. You go out on military leave, and then you come back, and you can buy that time. This is not military service that you served prior to your employment. Okay, that is not purchasable. Unless you did the military service before 1973, which, probably you did not. Okay, now these last two categories are kind of similar concepts, but different. The first one, a redeposit of a prior membership. This is where you used to be an ACERA member in the past, and maybe you worked for a few years and you quit, or whatever, your employment ended. And then when you left employment, you took a refund of your contribution account with ACERA, meaning all of your employee contributions that you paid in plus the interest that we paid to your contribution account when we earned interest. You took all that with you. Okay. And that means you lost all your service credit from that original membership with ACERA because you basically canceled your membership. You terminated your membership. Okay, now you're back working here, and you want to get that service credit back from that initial membership. Well, you can do that by paying that money back into the system that you had taken out. And that's called a redeposit of a prior membership. And we do that all the time. So that is an option for you if you're in that situation. Okay, the next category, redepositive community property. This is for people who get divorced or dissolve a state registered domestic partnership. Okay, so what happens is while you're married or you're in the state registered domestic partnership, the retirement that you're earning is considered community property when you go to divide the assets up when you get divorced or dissolve the state registered domestic partnership. So in many cases, what happens is your ex-spouse will negotiate to get part of the retirement benefits that you've earned, and that comes in the form of that breaking off part of your account for them. So they'll get a piece of your service credit and they'll get a piece of your contribution account. Okay, now if in the future, after that happens, they take a refund of their part of their contribution, their contribution account that has been broken off, we will notify you of that by sending you a letter in the mail, and we'll ask you if you want to purchase that service credit to get it back. Basically, it's called a redeposit of community property. So you would redeposit an equivalent amount and you would actually get that service credit back that they took with them. Okay, so, and there's a question, what's the interest percentage for service credit purchase? Let me talk about that in just a minute when we get there, because it varies based on how much interest the fund earns and how much we post to your accounts. Okay. And I'll show you where you can see all of the interest numbers for the past. Okay, last category, other California prior public service. This is where you used to work for a different public employer in California and you're not eligible for their pension because you took whatever pension you earned there, you left work there and you took a refund from their pension to terminate your membership with them. If that happened, you can actually buy that time as a SARA service credit. So for example, you worked for the Port of Oakland for 2 years, you quit, you took a refund from the Port of Oakland's pension. Well, you can buy that 2 years as a SARA service credit, okay? There's a more detailed article out on our website at acera.org/service, just to let you know. Okay, so because I gave you a list of times that are eligible for you to purchase, here is a list of times that are not eligible for you to purchase, because we always get these questions. I mentioned this earlier, vacation purchase time. When you purchase additional vacation on top of your earned vacation, you cannot buy that back. Okay, you don't get service credit for it while you're out on the purchase vacation and you can't buy it back. But like I said, it's not a huge deal, so I wouldn't stress out about it. Next category, any leave without pay that's non-medical, that is not purchasable. Okay, next category. I mentioned this earlier, contract time or temporary agency time, that where you worked for one of our employers prior through a contract or through a temp agency or employment agency, not purchasable. Those are the rules. Okay, final category, the other prior public service time where you still have your contributions on deposit with the other agency. So just to go back one slide, to give you that example, if you worked for that original example, if you worked for the Port of Oakland for 2 years, but you haven't, and you quit, but you haven't taken a refund of your deposit, your money on deposit over there yet, it's not purchasable until you terminate your membership over there, and then you can use that money to purchase it at Acera. Now, some people will ask, I have reciprocity with a different California public agency like CalPERS or a different county. Do I need to take a refund and then purchase that here? In many cases, you probably do not want to do that, especially if you have reciprocity. You definitely don't want to do that. You're already getting, if you have reciprocity where you've linked the systems together, you're already going to get credit with the other pension system for that time worked, and they're actually going to give you a pension benefit when you retire. So you actually do not want to take a refund. You want to leave your money there. The reason that you may want to take a refund is if you don't meet the eligibility requirements for their pension, like you only worked a couple of years and you need to get like over 5 years in their system to get anything, that's when you might want to think about taking a refund from their pension system. Or even if you don't have reciprocity, let's say you worked for CalPERS for 10 years, you quit, a year went by, now you have a job here, you can't establish reciprocity because there's too big of a gap. It was a year, but you are still going to get a benefit from CalPERS for that 10 years that you worked. It's probably more advantageous for you to leave it there and collect their benefit and retire from them. Okay. And again, for those of you who are curious about reciprocity, we will cover that in the second half of the presentation. Okay, now, how much is it going to cost to make the service credit purchase? It will cost you however much you would have had to contribute to the system had you worked the time. So let me give you an example. You go out on 3 months of unpaid medical leave, and then you return from that medical leave and you want to buy the time. Well, had you been working here for that 3 months, you would have been collecting a paycheck from your employer. And because you were collecting a paycheck, part of your paycheck would have come out and gone into Acera's fund. Whatever that amount of money would have been had you worked the time for that 3 months, that's the total that it's going to cost you to buy that 3 months worth of time. So you can do an estimate of the cost simply by going back to your pay stubs. You can like look at the pay stub before the time that you're trying to buy, or maybe immediately after, and see what your contribution is every pay period, and then you can add that up, what your contributions would have been over that time, to get a ballpark of what the contributions would have been. Okay, then to add to that, you can see a plus sign here on the slide. You are also going to have to additionally pay any interest that money would have earned between then and now. So to stick with the example, if you had paid into Acera for that 3 months where you were out on unpaid medical leave, we would have taken that money and invested it, and it would have earned interest. Okay. We have 2 interest periods per year, first half of the year to the second half of the year. So the interest period ends June 30th and December 31st. Every time one of those dates passes and you don't make the service credit purchase, that's another interest period that we're going to add on to the cost of, on top of the employee contributions that you will have to pay. Okay, so that's why I mentioned earlier that the longer you wait to purchase service credit, the more expensive it gets, because more interest periods pass, and it's more and more interest that you're going to have to pay in addition to the contribution amount. For example, if that 3 months of unpaid medical leave was 5 years ago, that's 5 Junes and 5 Decembers that have passed between the time that you're trying to buy and now. And so you would have to pay all that interest. And somebody asked earlier, well, how much is the interest? Let me show you where you can find that out on our website. Okay, so again, here's our website, acera.org. If you go under the employers category and you go down to contribution, I'm sorry, don't do that. Okay, one way to do it is to go to acera.org and just type in contributions, and it'll take you right there. This is the employee contribution rates page. The way to navigate there is to go under members, go to understanding your Acera benefits, and then contribution rates is one of the for selections under there. So again, members, understanding your benefits, contribution rates. Okay, scroll down. This is where you can actually see all your individual contribution rates. So there's a table showing you what they are based on your tier. So you scroll all the way down to your contribution account section. And then there's a question: how much interest does Acera post to my contribution account? It's based on how much we earn, but you can see how much we've posted to the contribution accounts for every 6-month interest rate period from now all the way back to 1993. And then for reference, it shows you what the equivalent year's worth of interest was. So you can see what that amount was. Additionally, there's an Excel file at the bottom. If you like to do math and you have some time that you want to purchase and you actually want to try to calculate the interest that you owe yourself just to get an estimate, you can download that Excel sheet, and it has all these numbers in it as well. Yeah. It's a slightly more complicated math problem, but it's doable if you enjoy math at all. Okay, so otherwise, if you don't want to do that, but you're interested in how much it's going to cost, all you need to do is simply send us a purchase redeposit request form. You can log into your account on our website. You go to acera.org/login, or this is the shortcut, acera.org/WMS, which stands for Web Member Services. And you fill out the purchase redeposit request there, and we will do our calculations. We'll send you a letter with how much the purchase, well, basically whether your time is purchasable, whether it qualifies, and then how much it's going to cost. And in that time, you can decide if you want to make the service credit purchase, and in many cases, how much of the service credit purchase you want to make if you don't want to make all of it. Let me go back to show you to the slide that shows you the categories. For all of the categories except for the redeposits, you can actually purchase a portion of the time. So if we tell you your year of unpaid medical leave is going to be $5,000 and you don't want to spend $5,000, you only want to spend $2,500, you could buy half the time if you want. But the redeposits are all or none. One more thing I will say about costs is when you're purchasing all of the bullet points except for the bottom one, you're only paying the employee contribution and interest. When you're purchasing the other prior public service, you're going to pay the employee and the employer contribution. And that means that it's going to be more expensive. It could be double or triple what the other categories cost. So that's definitely something to consider. And then if you actually do decide to make the service credit purchase, you have various options to pay for it. You can pay us in a lump sum check on a post-tax basis. And this is a good time to point out, when you're making your contributions, your normal contributions out of your paycheck to Acera, that comes out pre-tax. So that lowers your tax liability each year, which means you pay less income taxes while you're working, because part of your money is being diverted out pre-tax to Acera. It does mean that you're going to pay taxes on your Acera retirement benefit when you retire, but that's for the future. And then a second option is to roll over money from another type of retirement account. You can do that on a pre-tax basis if you have some money saved up. You could also do payroll deductions, and that's on a post-tax basis. So we'll split it up for you over time, or any combination of the above. So you could roll over some money, write us a check for some of the money, and then we'll split the rest of the cost up for you through payroll deductions, and it will become directly out of your paycheck, so you don't have to think about it. Okay, so now we get to the topic. People always ask this question, so I went ahead and made some slides on this. How do I know whether I should purchase the service credit or not? Is it worth it? Let me tell you how you can figure this out for yourself. The first thing that you're going to do is log in to your Acera account. Again, you go to acera.org, click the login button, or just type in acera.org/WMS. WMS. Okay, once you get in there, you are going to see, and I think I might have a screenshot, you're going to see an estimate a benefit selection. This is a tool, the benefit estimator, estimate a benefit. You're going to click on that, and you're going to use this benefit estimator to make two estimates, okay? For both estimates, what you're going to do is you're going to think into the future and come up with a plausible retirement date scenario for yourself. So you're going to think, well, I'm 30 now. I'm going to retire. Maybe I want to work 30 years and retire at age 60. So let me think of a date that is 60 years from now. 30 years from now. So maybe it's February 15th, because we're doing this on February 15th, 2053. You put that date in, okay? Or whatever it is for you. Just pick a plausible date here that you want to see what the effect of purchasing service credit would be, in this scenario. You put that date into the benefit estimator. there will be a service credit override field. And let me go back to the screenshot. It's this one right here. You leave this blank. You do not enter anything in here, okay? You just simply accept the projected service credit number that the estimator is giving you, and you click Get Estimate, okay? It's going to give you a PDF estimate with a dollar amount on it. I think there's actually an example. Do I have a screenshot of that? I don't. But there's a PDF that it gives you that has a dollar amount estimate on it. Okay. You save that PDF. Now, you go back, you do estimate number 2, use the same retirement date, so the exact same scenario. But in this case, you're going to override the service credit number with the amount that you're trying to purchase. So in this screenshot, you can see that in this scenario, this person is being projected a 21.27, and change amount of service credit. So if they're trying to buy a year's worth of service, they would just want to add 1 to this number and put in 22.27634 into the service credit override field, or whatever it's for you. If it's a half a year, put in 0.25, a quarter year 0.5, a quarter year 0.25, and so on and so forth. So you're increasing the amount of service credit for estimate number 2. You click submit. You get an estimate PDF where your projected retirement estimate is higher because there's more service credit in it. You're going to get a higher retirement allowance in the second scenario. Now, what you do is you take these two PDFs and you look at the difference between the two. You take the higher estimate and you subtract out the lower estimate to see what the difference is between the two, like how much more the estimate number 2 is based on you purchasing the service credit. So that gives you the difference that you will receive in dollars each month, starting at the time of retirement and for the rest of your life. Okay, then to figure out whether it's worth it, you got to simply take the purchase cost, and this will be on the letter that we send you in the mail, and you simply divide this monthly difference. This is the amount additional that you're going to get in your retirement allowance. So you're basically determining how long it's going to take you for you to get that money back, because your retirement allowance is larger. And this will tell you how many months it will take you to get the money back. So for example, your estimate number 2 is $100 more than estimate number 1 based on the service credit purchase that you're going to do. And we tell you that it's going to cost you $1,000 to make the service credit purchase. So you're going to divide the 1,000 by the 100. That's 10 months. It's only going to take you 10 months of increased retirement payments at the time that you retire to get the money back that you paid for making the service credit purchase. 10 months is virtually nothing in retirement. And so in that case, it would probably be worth it. Or maybe you do this little division and it takes a year or 2 years or 3 years to get the money back that you're putting out while you're still working to make the service credit purchase. That's probably worth it. 4 or 5 years, probably worth it. 6, 7, maybe, when you start getting into the 10, 15, 20 year, 25 year range, then you want to start thinking about, well, is this something I want to do? Okay, so it's up to you. This is a measurement of your appetite for paying money in advance to get a higher benefit in the future. And eventually you will get the money back, but this shows you how to figure out how long it takes to get the money back. Okay, so that's service credit. We talked about the age factor percentage. We talked about years of service credit, which was the most lengthy discussion of any of these three. We'll talk briefly about the highest average monthly salary and how we arrive at that calculation. And then we'll take a break. Okay, so let me tell you about how we arrive at this figure to put in the formula for you when you go to retire, highest average monthly salary. So when you go to retire, what we're going to do with our pension software is determine your period of highest pay during your entire career. This is known as your final compensation period. If you're in tiers 1 and 3, and this is one of the slides where I show you the differences between the tiers. If you're in tiers 1 and 3, your final compensation period will consist of your highest consecutive 26 biweekly or 12 monthly pay periods, depending on whether you're paid biweekly or monthly. Okay. For tiers 2 and 4, it will consist of your highest 78 biweekly or 36 monthly pay periods. Essentially, if you add all that up, for tiers 1 and 3, it's your highest consecutive year of pay, and for tiers 2 and 4, it's your highest consecutive 3 years of pay. Now, our goal with this calculation is to determine your highest average monthly salary. So we're going to need to get an average. So what we do is our software will look at the total pay, and this is gross pay that you made either during the 1-year final compensation period for these tiers or the 3-year final compensation period for these tiers, tiers 2 and 4. And it will simply divide by the number of months in that period to get your average monthly salary over that period. So that becomes your highest average monthly salary. It's basically your average monthly salary over your period of highest pay, your 1 year or 3 years. Now, what pay is included? Well, your base pay, of course, is going to be included. And again, this is gross pay. Now, gross pay before any deductions are taken out. In some cases, other pay codes may be included. And sometimes these are known as footnotes. They're usually other types of pay based on your skills or based on your education level. And some of these may count, some of these may not. I can't tell you off the top of my head whether your pay code is in or out because there's 1,000 pay codes. But we do have a chart for you where you can figure out whether your pay code is in or out of the equation. You can simply go to acera.org/paycodes. I can show you how to navigate there. Again, this is our website. This is actually going to be under the employers heading, and you just go down to pay codes. And then you'll see a PDF for each one of our employers. Not sure why the Housing Authority is on there twice. I'll get that fixed later today. It could be somebody updated it and didn't remove the old one. So you simply click on the PDF. It'll pop open the PDF. And let me just zoom in here. You can see that all the pay codes are listed out by number and by name. You find your pay code and you find your tier, and it'll say yes or no whether it will be in or out of this salary calculation equation. You can see, how many different pay codes there are. That's how that works. So your pay code may be included, it may not be included in this calculation. One pay code I can tell you that never counts is overtime. And if you need more help finding your pay code on the chart, you can ask your payroll manager for more info, and they can help you identify the pay code. Okay, 2 more bullet points I just want to mention very briefly. If you're in tiers 1 and 2, not tiers 3 and 4, vacation sales made during that final compensation period and vacation cash out that occurs where you still have vacation left over on the books when you stop working and go right into retirement in many cases, you'll get cashed out for your vacation that's still on the books at that time. And some of that money can be included as pay for the purposes of calculating your highest average monthly salary. That is a whole discussion. We don't cover that in this webinar, but we do cover it in the pre-retirement webinar. So if you want to go check out one of the pre-retirement webinar videos out on our site, if you're interested in that topic, you can simply fast forward through the video until you see this slide. The slide looks the same. And then there's a whole discussion of how these two can increase the amount of salary for the purposes of calculating your retirement allowance. We do have also a post out on the website at acera.org/vacation that will give you some information on that as well. Okay, there are some limits on your retirement allowance benefit payments that we are allowed to pay out. One of the limits is that we cannot pay out more than 100% of your highest average monthly salary, which means that whatever your salary was before retirement, we can't pay out more than that in retirement. But that is a good problem to have, because that means you've achieved 100% salary replacement, meaning you've replaced 100% of your working salary with your retirement allowance from your pension alone. So that's a good situation to be in. So if you do hit that limit, I wouldn't worry too much about it. There are a couple of other limits that you can read about on our limits page, acera.org/limits, for people who are in the other tiers, tiers 1, 2, and 3, who have really high salaries, maybe over like $250,000 per year. Since that doesn't apply to most people, I'm not going to cover that. But go ahead and check out that acera.org/limits page if you do have a high salary. But for a lot of people, a lot of tier 4 people, there are a number of people who may hit this tier 4 limit. And the way this works is, this is one of the things that was written into that pension reform law. Acera is not allowed to consider more than a particular annual limit of salary for the purposes of calculating the salary component of your retirement allowance. Okay. So for general members, the cap for 2023 is $146,042. For safety members for 2023, the cap is $175,250. Okay. If you earn more salary than this during the year, all the pay period, all the salary that you earn for the rest of the year after you hit this cap will not be considered for the purposes, like later on, will not be considered for the purposes of calculating your retirement. That's the bad news. The good news is that we also will not take out retirement contributions for any pay periods where we are not allowed to consider that salary for calculating your retirement. And that will leave you more pay in your pay stub, in your paycheck, to save in your 457B account or in your additional savings. It's not something that we control. That's just the way the law is written. And the cap does increase every year. It's based on some Social Security number that's set by the federal government. And you can read more about what the cap is every year, what the current cap is, on that acera.org/limits page. Okay, and there's a question, does that mean you will not get COLA each year if you have reached 100%? So this is going back to that first limit that I was talking about, where you can't receive more than 100% of your final average salary in retirement. And the answer is no. You will still get the cost of living increases. That limit simply means that if you hit 100% salary replacement, we will calculate your retirement allowance to be, at the time that you retire, 100% of your final average salary, your highest average monthly salary. And then we start paying you that amount in your retirement, but then you will get cost of living increases. Everyone gets cost of living increases throughout the rest of their retirement every year on April 1st. And there's a question, is the cap the same for other retirement systems? I can't speak for CalPERS because they have slightly different rules. That's the state's retirement system. The other county retirement systems, I'm going to take a wild guess and say that that cap probably does apply. And because a lot of the county retirement systems are governed by the same rules, but you would want to check with those systems to see if that cap applies. It's actually really hard to hit that cap. For tier 2, you got to work like over 40. You got to have like at least 40, 45 years of service credit and be pretty old for a certain age to hit 100% salary replacement. So most people do not hit that. Actually, on average, we find that our acera retirees retire with 20 years of service credit. So in most cases, you're not going to hit the 100%. I see a question up there, is a federal mandate. Well, I don't know which limit you're talking about. Both of these limits are state rules. That the one that I was talking about, the 100% FAS, or the 100% salary limit, and the this limit here for tier 4 people, this is a state rule, but it's based on these federal Social Security numbers. And I see a question in there. What happens if you leave an acera member organization, like you leave acera and you go work somewhere else that's not affiliated with acera? We will cover that in the second half of the presentation when we talk about some career planning options and what happens when you when you leave employment with your employer. Okay, so to put it all together, this is the last retirement basics, pension math thing, just to put the whole thing together, just to review what we learned. Here is an example of us calculating the retirement formula for this member who is retiring. So this is a tier 4 member. They're retiring at age 65 after earning 25 years of service credit. Okay. So since they're in tier 4 and they're retiring at age 65, that means that their age factor percentage is going to be 2.30%. And we get that out of their age factor percentage chart. They are going to receive 2.30% of their highest average salary for each one of these 25 years of service, because they have worked 25 years. They've earned 25 years of service credit. They either worked 25 years full-time or they worked the equivalent of 25 years full-time. Maybe they worked 22 years full-time and then they worked 4 more years half-time. I'm sorry, 22 years full-time, and then they worked 6 more years half-time to get up to the 25. You can do that. Okay, so what we're doing here is we're multiplying these 3 things together. 2.30% times 25 times the $6,000 average monthly salary that this person has, and that equals the $3,450 monthly retirement allowance. They will receive this every month for the rest of their life, plus cost of living increases every year. Now, just to give you a few more details, if we multiply the 2.30% times the 25 years, you will find that that equals 57.5% salary replacement. So they're achieving 57.5% salary replacement. They are getting, as their retirement allowance, 57.5% of their working salary. Their highest average monthly salary here is $6,000. And that 57.5% of the $6,000 is $3,450. Okay, now remember, just to bring back an earlier concept, remember I told you financial planners will tell you you need 70 to 80% of your working income in retirement to maintain your standard of living. You can think of that 70 to 80% as a salary replacement target, okay? So this person is achieving 57.5% salary replacement just through their pension, their Sarah pension alone. That's really great because they're going to add probably Social Security to that later and maybe some additional savings to get to that 70 to 80% mark. Okay, let me show you how to get highest, and there's a question, is highest average monthly salary gross or net? It's gross before any deductions are taken out. And is the salary pay? Yeah, the pay rate, it's the salary pay rate. It's gross, not the take-home pay. So if you look at the top of your pay stub for how much you're earning before any deductions are taken out, that's what we're talking about. Let me help you get a pension estimate. Okay, so we talked in general about what the future may hold, how we calculate those numbers for you, how we calculate your retirement allowance when you go to retire. And by learning that, you've learned how to maximize those 3 numbers, how to maximize your age factor percentage, how to maximize your years of service credit. So you maximize your age factor percentage by getting older. You maximize your years of service credit by working longer, working more years. And you maximize your salary by simply, getting cost of living increases or getting raises or perhaps, higher and higher positions that come with more and more pay. Another way that you might do that is by jumping ship, going to a different retirement system and establishing reciprocity. We'll talk about that in just a few minutes, okay? So what I'm going to do is I'm going to show you how to get a specific estimate of your specific pension, not just in general. I'm going to show you 2 ways. The first thing I'm going to show you is this ballpark replacement chart way. This gives you a ballpark percentage of how much of your salary you'll get as your retirement allowance. So one way to navigate to find these charts is to go to type in acera.org/planning in your browser. But I'll show you how to get there from the website So again, here's our website, acera.org, and you go under members, you go down to the third option, planning your future retirement income. And this is a step-by-step process for some of the things that I'm talking about in the webinar. And this is the step-by-step process in detail. And step one is showing you how to get in a Acera retirement estimate in 4 different ways. And I'm going to tell you about the first 2, options 1 and 2. And the first one is using one of these charts. So you just scroll down to your tier. Okay, I'll open the general tier 4 member chart. What this is showing you is the combination of different scenarios of years of service credit and age at retirement, and how much of your retirement allowance is going to replace your salary. So let's say that what you do is you think of your retirement scenario. So let's say I'm 30 and I'm going to retire at 60, which means that I will have worked 30 years. Okay. Or let's say I'm brand new, and that means I'll have worked 30 years. So what I'm going to do is find, just to zoom in here a little bit, find where those 2 things intersect. So you can see years of service credit down on the y-axis, and you are just going to want to scroll over until you get to the age that corresponds to, in this example, age 60, and where they meet is 54%. Okay. So that means that if I were to retire as a tier 4 general member at age 60 with 30 years of service credit, my retirement allowance would replace 54% of my working salary. So I'm achieving 54% income replacement. And then if you want to, you can just kind of think about your current salary, and you can just multiply that by the 54% to see how much dollar-wise your retirement allowance would be. Okay. Another interesting feature of this chart is that this allows you to see what your income replacement percentage would be should you work more or less than you are thinking about in your imaginary scenario. So let's say that I want to see what happens if I work another year. In another year, I'll be another year older, and I will have earned another year of service credit. So I'll just proceed diagonally to the intersection of 61 years of age and 31 years of service credit. And that gives me 58.90% income replacement. If I work another year, I'll go diagonally one more, that gives me 64% income replacement. So you can see that it jumps quite considerably the more and more you work. Or if I want to see what happens if I work a year less, I'll just go diagonally backwards and retire at age 59 with 29 years of service credit, and I'll achieve 49.30% salary replacement. Okay, so that's just a nice quick ballpark way to see how much of your working salary that your pension will replace. Now let me show you how to get a precision estimate that will give you a dollar amount. And let me see, there's a question up here. So you're saying if a 52-year-old retires after 5 years vested, they would get a 5% salary replacement. Let me go back to the chart. It sounds correct. That is correct. So if you retired at age 52 as a general member with 5 years of service credit, you would get 5% salary replacement. Okay, going back to the presentation. So method 2 for getting a retirement estimate is using the benefit estimator. You go to our website, click the login button. Once you log in, you'll see this account summary screen. And this is where you can see a lot of your demographic info and a lot of the pension data that we have for you. You can see what your tier is. You can see your employer, reciprocity, whether you have it or not. Your date of birth is in there, employment date, your date of entry into Acera, how much service credit you've earned so far, how much you've contributed to the retirement system. If any of this stuff seems off, then go ahead and contact us, because it's best to get that stuff corrected earlier rather than later. Okay. And you can contact us by going to our website, going to acera.org/contact, or if you go under the About menu, there's a contact link in there, and you can send us an email through our web form, or you can see what our phone number is in there. Okay, so once you get in here, though, in your account, click Estimate a Benefit. And then what you're going to do in this case is you're going to need to come up with a couple of dates. So you want to think of maybe a more precise scenario. But you can just pick a general date if, because your retirement is going to be a ways off. So if you're going to retire 20 years from now, pick February 15th, 2043. And then you just put that in. Okay. Your separation date is your last day on payroll, your last day of work. Your projected retirement date is your first day of retirement. These have to at least be 1 day apart. So just pick a scenario where it's 2 consecutive dates if you plan on working straight into retirement. Now, if you're someone who is not planning on working straight into retirement, you can do that too. If you're going to quit working and you're going to defer your retirement to a later date, you can just simply put in a couple of dates here that have a gap between them that fit that scenario. And then you hit calculate. Okay, and I'm going to just zoom in here. You hit calculate, and then what it will do is project the amount of service credit you will have earned in this scenario, because it knows how much you already have because of your payroll records, and it will do a salary projection for you based on your current salary. Now, you do have the opportunity to override both of those numbers, like we were talking about earlier. If you want to see what the effect of purchasing additional service credit is, you can add that to this number and put the new total in there. Or if you're going to retire a ways from now and you want to see the effect of a higher salary, you want to multiply some cost of living increases into there, you could do that too. You can override the salary figure and see what the effect of a higher salary would be. If you want a nice conservative estimate, you just leave both of those blank and leave this hours of cash vacation compensation field blank too. You can put in beneficiary info in if you want, and you click get estimate, and you end up with this PDF benefit estimate. And I'm just going to zoom in so you can see it a little bit better. It's up here, it's telling you the information it's using to calculate the estimate, and then down here is your actual estimate. Now, it's got a lot of details in here for people who are getting ready to retire. It shows you an estimate of the 5 different retirement options. Well, four of the 5 anyway, retirement options that you're going to choose from at the time of retirement. For new employees and people in the middle of their career, that's not something that you are probably going to decide right now, because your life is going to look different by the time you get there. You're going to have different beneficiaries, or you're going to want to do something different. So my advice would be to ignore options 1 through 4 right now and just look at the unmodified option, because this is what most people pick anyway, because it pays the highest retirement allowance of any of the other options. So you can just look at this number right here and go on that as your precision estimated retirement allowance from the benefit estimator. Okay. Now, let's talk about your retirement eligibility, because you're not eligible to retire right when you start. You got to do you got to meet some criteria to become eligible to retire. So let me show you what those criteria are. And to go back to the pension milestone chart, we're talking about this milestone here. This is when you become retirement eligible based on a combination of years of service credit and age. So here are the combinations. Here's the criteria. I'll show you tiers 1, 2, and 3 first, and then I'll show you the slide for tier 4 next. So combination number 1 is for tiers 1, 2, and 3, excuse me, I apologize. You are at least age 50, you're age 50 or older, and you have 5 years of service credit, and you have at least 10 years of membership. Okay. Now, the 5 years, the way this works is if you're planning on going straight from active work into retirement, you can kind of think of this as working for 10 years, you get 10 years of service credit, or you work for 10 years and you're over age 50, and then you can retire. But if you leave early, if you earn like 7, 8, 9 years of service credit and you leave, you can become a deferred member. You just have to wait until you have achieved 10 years of membership, which just means at least 10 years has passed since your date of entry, and you're over age 50 and you can retire. Okay. Option number 2 is that as a general member, you can have 30 years of service credit, or as a safety member, you can have 20 years of service credit and retire at any age, even if it's younger than age 50. Option number 3 is that you can have any amount of service credit, even if it's less than the 5 years of service credit you need for option number 1. You can have any amount of service credit and retire at age 70. Okay. Those are your 3 options. Okay, now for tier 4, you have 2 different sets of options for becoming eligible to retire. Option number 1 is that you are at least age 52 as a general member, or at least age 50 as a safety member, and you can retire with 5 years of service credit. Option number 2 is that you can retire with any amount of service credit, even if it's younger than age 50. So if you have 4 years of service credit, you could actually wait until you're age 70. You could just leave that 4 years with us, leave your contributions on deposit, even though you're done working. And at age 70, you can start drawing a pension from Acera. I mean, it'll be a pretty humble pension, I will say, because it's only based on 4 years of service credit. But it could be enough to pay like all your bills or all your monthly bills in retirement or something. So it's in almost all cases, it's a good deal just to get the retirement allowance, even if it's not very much. Okay, let me talk briefly about additional benefits. In addition to the vested benefits, so the monthly allowance, the COLA, the cost of living adjustment, we have some non-guaranteed benefits that are medical, dental, vision, and a few others, a couple of others. They're not guaranteed benefits, but they are these extra benefits that we do offer. We also have disability retirement, which is considered a vested option, a guaranteed option. Should you become permanently disabled and can no longer perform your job duties, you can apply for disability retirement and go out on a disability retirement. And if you want more information about that, we have a whole page out on our website about disability retirement. And so I don't take a deep dive into that here. Also, death benefits is something that we offer. There are death benefits that I've alluded to a couple of times in the presentation that your beneficiaries will be eligible for after you retire and pass away. There's also a set of death benefits that I'll talk about in just a minute that your beneficiaries would be eligible for should you die before retirement. Okay, and so it's good to know what those are. Let me talk first about the medical, dental, vision, and other non-guaranteed benefits. And I'm just going to touch on this briefly, just to let you know that this exists and it's out there. And this will help. This could help you with some of your career planning. Okay, so at some point in the past, I think in the 80s, the county decided that their retirees needed an extra set of benefits to help pay for their lives in retirement. And so they started a reserve fund to pay for these medical benefits. Our board of retirement is in charge of administering this fund, and their entire goal is to ensure that the fund stays sustainable into the future. So what they do is they keep track of how much is going out of the fund, paying in these benefits, and they keep track of how much is going into the fund. And so they set the benefit levels and the rules around who gets these benefits based on keeping this fund sustainable. Now, currently the fund is more sustainable than it's ever been. There's over $1 billion in the fund, and the sustainability measure is the highest it's ever been. So it's doing pretty well. Now, The non-guaranteed benefits are, the first one is a medical subsidy, and MMA stands for monthly medical allowance, and that's just simply the name of our medical subsidy. The medical subsidy is to help you pay for the cost of being enrolled in one of Sarah's medical plans that we offer you the ability to enroll in after you retire so you can maintain medical coverage into retirement. And then we offer a subsidy for that, that helps pay for the cost of that. There's also a dental subsidy, vision subsidy. Those actually both pay 100% of the monthly premium for the dental and vision plans. There's a Medicare subsidy that helps pay for the costs that the federal government charges you for being enrolled in Medicare Part B. There's also a supplemental cost of living adjustment. One of the reasons that I like to just tell you that these exist right now, even though you're either new employees or in your mid-career, and the medical plans, the dental plans, vision plans, all that stuff is probably going to look a little bit different, perhaps a lot different by the time you get there. I like to talk about this now is because I like to show you the years of ACERA service credit it takes to qualify for these benefits, because that can help you plan out your career. Okay. So again, the Board of Retirement, they're the ones that set these rules. Okay. So the only one of the benefits, as you can see, that requires no years of ACERA service credit to qualify is the supplemental cost of living adjustment. This is an extra cost of living adjustment that prevents you from losing more than 15% of your buying power in retirement. It's a very powerful benefit. That's the only one that everyone has access to, regardless of years of service credit. For all the other ones, they start at 10 years. You have to have at least 10 years of ACERA service credit to start qualifying for these subsidies. And then you can see the monthly medical allowance has a couple of higher levels that it pays a higher and higher subsidy at 15 and 20 years of service credit. So I like to say that when you're doing your career planning, for example, maybe you've been working here for 9.5 years and you're thinking about going and doing something else. Like, is this for me? Maybe I want to go try something else in my life. Well, if you're at 9.5 years, maybe you want to stick it out another 6 months, get over the 10-year mark, because this could represent a lot of additional money in retirement, because it's going to subsidize your medical, dental, vision, and Medicare just by getting over that 10-year mark. That's why I actually like to put in an additional milestone in here where the healthcare subsidies kick in at 10 years. And then you could even put, 15 and 20 years in there as milestones for the additional levels of the medical subsidy. So it's just something to think about. Like maybe you might want to plan for achieving these milestones. And somebody asked about 21 years for the medical subsidy. The full monthly medical allowance starts at 20 years of ACERA service credit. Okay, so let's talk about, since we're talking about benefits, let's talk about death benefits and designating your beneficiary or beneficiaries. Let's define this term. Beneficiary is someone who gets benefits. Your ACERA beneficiary is the person that you designate to get your ACERA death benefits. So, and again, what I'm talking about here is purely the death benefits should you die before retirement, because the death benefits after retirement, it's a whole other topic. We do that in the pre-retirement webinar. Okay, so death benefits before retirement. Should you die in while you are still actively employed, and I'm not saying that you're dying at work, you're just dying while you have a job, your current job, your ACERA covered job, and you're not vested, meaning you have less than 5 years of ACERA service credit, what your beneficiaries would receive would be a return. It would be basically a refund of your contribution account. So all of your employee contributions you paid in plus the interest we posted there. They would also receive 1 month of salary for each year of service that you've already done, up to 6 months worth of salary. So if you died after you worked here for 3 years, they would get 3 months worth of your salary. Okay, now, if you die after you're vested, and again, you're in active pay status with your employer, your beneficiaries would receive a choice. Option 1 is the same. they would still get that same option that the beneficiaries of non-vested members would get. Same option. Option number 2 is a monthly survivor's allowance. And so this actually simulates you retiring as of the date of your death. And then it pays a monthly survivor's allowance to your spouse or state registered domestic partner for the rest of their life, or it pays, if you don't have one of those people, but you have minor children, it could pay a monthly survivor's allowance to minor children, but up to, I think, age 18 or 22 if they're enrolled in school, in college. And there's more details about that out on our death benefits page, which is acera.org/death. There's also option number 3, which is 1 month of salary for each year of service up to 6 months and a reduced monthly survivor's allowance. So it's kind of a combo of 1 and 2. And this is not something that you designate ahead of time. This is something that we offer your beneficiaries upon your death, the choice of one of those 3 options. If you die as a deferred member, now again, you're not in active pay status, you've already terminated your employment, but you haven't retired yet, your beneficiaries would simply receive a refund of the balance of your contribution account. Okay, again, there's more details at acera.org/death. And I want to emphasize this because we're paying out who you tell us to pay. You need to tell us who to pay. The beneficiary that you've designated for your life insurance, that's totally separate. Beneficiary that you've designated on any of your financial accounts, that's totally separate. You have to designate your beneficiary for Acera individually with Acera, and you do that on our beneficiary designation form. And you probably have already done this because we ask you to designate one on our member enrollment form that you signed whenever you started. But it's good to go ahead and check. Log into your account, click on nominated beneficiary, review who your beneficiary is nominated. If there's no one there, or if your beneficiary is your spouse from 3 spouses ago, you're going to want to go ahead and redesignate your beneficiary. And there's actually some links in there on that page that will take you right to the beneficiary designation form. Okay, let's talk about understanding some career planning options. This is where you are ending your employment with your current employer. Now, option number 1, if you are eligible, when you are ready to end your employment with your current employer, if you're eligible to retire already, then option number 1 is to retire. You work straight into retirement and you retire. If you retire, you will earn service credit right up to the time you retire. We will convert your sick leave on a 2-to-1 basis to service credit up to a cap. There's more info on that in our pre-retirement webinar. And you can even go work somewhere else if you want, okay? And we don't care. You're going to be an Acera retiree. We're going to pay you every month for the rest of your life and go work wherever else you want. Now, if you try to come back to work for your employer or one of our 6 participating employers, there's restrictions on that, and you can read about that on our website. But again, if you go work somewhere else, you're still going to get your Acera retirement benefit. Now, let's talk about what happens if you're not going to retire when you stop working. If you're going to stop working and then you're going to maybe retire at a later date, or you don't know what you're doing yet. Here are your options. And there's 3 options that I'm going to tell you about. And I'm going to letter them A, B, and C because I've already numbered these first categories 1 and 2. These are kind of sub options about terminating before retirement. So if you're terminating before retirement, your pension milestone chart would look kind of like this. There's going to be a date where you stop earning service credit at the termination of employment, and then your retirement date is some day later. Okay. So option A is you can maintain your Acera membership by becoming a deferred Acera member. You're still an Acera member. You're deferring your retirement to a later date. And you simply do that by leaving your contributions on deposit with Acera, by not taking a refund. Okay. If you do that, interest accumulates. In fact, there's no negative interest. This is an amazing place to keep that money parked. If you looked at the interest chart that I showed you earlier in the presentation, the interest that we post to your accounts tends to be in the 6 or 7% range per year with no risk. If the fund experiences adverse investment experience, we lose money. You don't lose any money. We never deduct any money from that account because of our investments. Okay, so the money only grows risk-free, and it's just an amazing place to park your money. You can also retire later out of deferred status. Okay, so if you stop working now and you don't know what you want to do yet, you can, just be on hold, be a deferred member, and then you can retire later out of deferred status simply by submitting a retirement application and retiring, and then you start drawing your pension. Or you can decide to come back to work later and earn more because you haven't retired yet. So you could come back to work for one of our employers and earn more and more credit. And then you pick back up where you left off. You start paying into the system again. You start earning more service credit. Okay. So you could also be refunded at any time. You still retain that option as a deferred member. So if you're going to stop working and you don't know what to do yet, it's good to just become a deferred member and think about it a while, because you do retain the right to retire later once you become eligible, or you could be refunded later. Okay, that's option A. Option B is establishing reciprocity. Okay, so establishing reciprocity is linking the various different retirement systems together, linking more than one retirement system together in California retirement systems. So some places have their own retirement system, like a few cities in California, many of the counties in California. The state has its own retirement system. Some agencies do. We have reciprocity agreements, reciprocal agreements with many of the cities in California, the state, and any agency that's too small to have their own system, but they use CalPERS, which is the state system, or any of the state jobs or any county in California. So if you go get another job with one of those places, there's a full list at acera.org/reciprocity, then you can link the systems together. And why would you want to do that? Okay, well, there's 3 reasons you might want to do that. One is that you are committed to public service and you want to go get another public service job, but maybe you see that there's a better job somewhere else and you don't want to start over from scratch in earning your retirement. Well, when you link the systems together, it kind of prevents you in these 3 different ways from starting over from scratch. And one of those ways is that the service credit you earn under all of those systems is combined for the vesting and retirement eligibility requirements. So let's say you're tier 4. You're already age 52. You work for 2 years in Contra Costa County. You come over to Acera, you work for 3 years. That's 5 years combined if you've established reciprocity, and that gets you over the vesting and retirement eligibility requirements. Okay, the second benefit is that the highest salary, the highest average salary that you earn under any of those systems, all of the systems will use when they calculate your retirement. Okay, so let's say you work here for 10 years, you go over and work in Custer County for 5 years, and then you're going to go to retire. Well, we're each going to do a retirement calculation for you. Okay, Contra Costa County is going to use your 5 years over there, your age factor percentage over there, and then they're going to use your salary over there, probably because it's higher. So let's say that you're making a much higher salary over there. That's why you took that job. Okay, then Acera separately is going to do our own calculation using your 10 years here, your age factor percentage here, and then we're going to call up Contra Costa County and see if your salary is higher over there. And if it is, we're going to use that salary to calculate to you with the 10 years that you earned here. So that's another way that it prevents you from starting over from scratch. And if you are in tiers 1, 2, or 3, it keeps your contribution rate lower. Now, to qualify for reciprocity, you simply got to do 4 things. One is you leave your contributions on deposit with all the systems you're linking together. So you go get another job in Contra Costa County. You leave your contributions on deposit with Acera. So you're basically choosing option A, becoming a deferred member with Acera, and then you're choosing option B, getting a reciprocal job somewhere else. Okay. And then you can link more systems together, like maybe another job that pays better comes open at Marin County, and then you decide to move over there, and you can link that together. You can have all 3 of them linked together, link together 4 or 5, go crazy. As long as no more than 180-day gap exists between the termination date from the first job and entry into the next retirement system, which is about 6 months. If there's a bigger gap than that, then you can't establish reciprocity. You also can't have overlapping service, so don't go on a 4-week vacation here, and you're still on payroll on vacation, then you immediately start in the next job. Just don't do that, because that will prevent you from establishing reciprocity. All you need to do is quit your job here, make a clean break, start your next job over there, and they're going to cash you out for your vacation anyway, so you're going to get all that cash anyway. And then you got to retire from all the systems on the same day. So that's reciprocity. Now, your third option, option C, is to take a refund. So when you terminate your employment and you don't retire, you can take a refund. And what you're basically saying is that, where is it? You're saying, I don't want to be an ACERA member anymore. I don't want to collect the retirement allowance for the rest of my life. I don't want access to any of the medical benefits or medical plans, death benefits, none of it. Just give me my money. You can do that. And if you take a lump sum payment, you may lose a third of it immediately to taxes and penalties. Now, to avoid that, you can roll over that money into another type of retirement account, pre-tax retirement account. But refunds take a long time, 45 days, 60 days, maybe more. Okay, so it's not an instantaneous thing. And again, you're canceling your ACERA membership and you're not accessing any of the benefits. And let me just give you a little pitch for not doing that. I told you at the beginning of the presentation, if you retire from ACERA, you're going to get all the money back anyway within the first 3 to 5 years of retirement. And everything after that is this like pure bonus for you. So just go ahead and retire. Like if you're eligible to retire, if you're going to be eligible to retire, you go ahead and retire from ACERA. And then you get the lifetime benefit versus the one-time lump sum payment. And additionally, if you leave your contributions on deposit with ACERA, again, it's a place that your money grows risk-free. Okay. Let me mention a couple more things. Sometimes people, regarding deferred membership, people ask about becoming a deferred member, and I should make a slide on this. Good reasons and bad reasons for becoming a deferred member. Here's a good reason. You don't know what you're going to do yet. So go ahead and become a deferred member if you stop working. Okay. Another good reason, you are not eligible to retire yet, but you're done working. So you just got to wait for the age requirement maybe. Okay. Become a deferred member, wait for the age requirement, and then you can retire. Another good reason is you're not sure whether maybe you want to come back to work for one of our agencies and earn more credit toward retirement. Well, then you become a deferred member. Okay. Another good reason is because you're going to establish reciprocity. Go ahead and become a deferred member. Here's a not good reason to become a deferred member, which is that you're already ready to retire, but you want to wait a little bit for your age to get higher so that you have a higher retirement payment. Maybe you're going to like wait 2 years so you have a higher monthly payment in 2 years because your age factor percentage is higher. Yes, that's true. You will get a higher retirement payment, but you're missing out on 2 years worth of monthly payments in that example. So, and you're never going to catch up. If you can do the math yourself, and you will find that based on the payments that you're missing out, you're never going to catch up. So if you're already eligible to retire and you're done working, go ahead and retire. But go ahead and do the math for yourself. You can see. Okay, now I'm gonna talk about making a retirement planning picture, and I'm running a little behind, so I'm gonna cut into Gene Hilliard's time a little bit. So sorry about that, Gene. But this is gonna take about 15 minutes. The exact same thing happened yesterday when we did this webinar. So sorry about that. Okay, so what I'm talking about now is I'm revisiting that idea of what your income is going to look like after retirement. Okay, so you've seen the slide before. I showed you this at the beginning of the presentation. These are going to be the sources of your income after retirement. Your ACERA monthly pension, Social Security, if you are paying in the Social Security system, if you pay into it for at least 10 years, and then Anything on top of that is your savings and investments. And through a combination of those sources of income, financial planners will tell you that you're gonna want to target 70 to 80% income replacement from these sources of income, meaning that whatever you were making before retirement, you're going to need 70 to 80% of that to maintain your standard of living in retirement. Now, when I turn it over to Gene in a few minutes, he's going to try to get you to 100, but we'll just talk about 80% for the moment. And I'll let him give you the pitch for 100%. Okay, so here's an easy way to think about this. Okay, you're gonna take a little journey into the future. You're gonna use a magic time machine just for a little window into the future, and you can do that with your monthly SARA pension using our benefit estimator. You can do that with Social Security using the Social Security's estimator tool. And if you need to, if these two don't quite get you up to the 70 to 80%, you can also use technology. There are some calculators out there that I'll show you that will help you estimate how much additional to save now so that by the time you get to retirement, you will be in the range of 70 to 80%. So let's do this step by step, okay? Step one is you get your ACERA retirement estimate, okay? So again, and you're also going to get a Social Security estimate, okay? So again, for the ACERA retirement estimate, you're logging in, you're going to estimate a benefit, you use the benefit estimator, and then you end up with this ACERA benefit estimate PDF, okay? And then you're going to look at the unmodified option. You're also going to be cognizant of the age at retirement, because you may not know, and there's a good chance you may not know what age you're going to retire at this time, okay? So you can kind of take a guess. Maybe I want to retire 60 or 62 or 65 or 64, whatever it is. It might actually be good to do this process for a few different ages just to see how it all works out and how much additional you might need to save or how much the pension and Social Security is going to cover. But to start off with, just like pick an age. And so I'm going to, for this example, pick age 62. And according to my ACERA estimate in this example, is about $2,200. Then I'm going to go out to Social Security's estimator tool, and I'm going to go through that. It's very similar to ACERA's estimator tool. You log in as yourself, and it has your Social Security data in there, and it will help you get a precision estimate of your future Social Security income. And what you'll see in the end is a screen that will look kind of like this. It'll show you a few different ages and the different amounts of Social Security income you will receive should you take Social Security at these different ages. Since we're doing an age 62 scenario, I'm going to stick with age 62, okay? And you can just, get out paper and write this down, or print out, make all these printouts and have them handy, okay? So in this scenario, at age 62, my ACERA income is going to be about $2,200. My Social Security income is going to be about $1,700. Okay, then for the third part of the formula, for these additional savings and investments, I'm going to use a retirement calculator. And this is going to tell me if I'm achieving the 70 to 80% income replacement through my pension and Social Security alone, and if not, how much additional I might want to save, might want to think about saving. I recommend trying a bunch of different calculators because they'll all give you a little bit different number. So it's good to kind of like diversify your calculator usage. If you are in the 457B program and Prudential has been transitioned to Empower and you log in there, they do have a retirement calculator in there that will help you do this stuff as well. I'm going to show you the Vanguard calculator, okay? And this is a screenshot, but I'm actually going to go out and do it live. So let me go back to our website here. Okay, so again, the page that I'm on is the planning your future retirement income. So you go under members, it's the first option, and then the third option, planning your future retirement income. So I'm on this page and I'm going to scroll down, and actually this is a step-by-step process for what I'm taking you through right now. So if you want to do it at your leisure, you can use all of our links. We link out to the Social Security estimator. It shows you when you can collect Social Security, and there's a link out to the Vanguard calculator from there.
Okay, so what this is doing is it's asking you for some information about yourself. In this fictional scenario, let's say that I'm 30 years old and we're doing a age 62 retirement just to see what happens. And it wants to know what your salary is. Let's say it's 70,000. And let's say that, so right here, what it's asking is how much I save annually. So if you do already have an annual savings amount, you can go ahead and enter that here. I'm just going to leave this blank for right now. Let's say I don't save anything annually. Let's see what happens. It's also going to ask you how much you've already saved. Well, maybe some of you have saved 0 so far. Totally cool. Don't stress out about that. Leave it blank. 0. Okay. And then this is the income replacement percentage that you're targeting. So I'm going to put in 80%, which means I already explained that, so I won't go into it again, but 80% income replacement. This number right here is an expected annual return on your investment. So what we're going to be doing is figuring out how much additional money we're going to save. And then the idea is that we're going to park it somewhere where we are going to earn some interest. So this number should be somewhere between 2% and 7% in my personal opinion. 2% is very conservative, and there's a lot of places where your money is virtually safe, where you can earn 2%. 7% is what we think we're going to earn. That's our expected annual return for Sarah's investments, and we're also pretty conservative. I'm just going to go to 6% to kind of estimate a more conservative investment risk, where I'm putting my money in somewhere that has the potential to earn interest, but it's very, very well diversified. And 6% is, it's a good estimate for that idea. It's, for example, if you're taking your money and you're saving it in the 457B account, and you're choosing one of the ways that Gene Hilliard is about to tell you to really diversify your investments in the 457B account, 6% might be a good, 6 to 7% might be a good expectation of the annual interest that you could earn over the years. And we're talking about long periods of time. So you're not necessarily going to hit that every year, but if you look at it over 20 or 30 years, that's like a good conservative expectation of what you could earn by leaving your money in the market. Okay, now I'm going to put in what I got from the Social Security website, 1,700, and from Sarah's website, which was, let's see, what was that? 2,200. So this is my Sarah estimate. And then I'm going to click calculate. Okay, now it's showing me a graph. And the bar on the left represents how much income I'm going to have in retirement. And the bar on the left represents how much I'm going to need. Now, you don't have to, since this is so far in the future, you don't necessarily have to pay attention to the dollar amounts. But the goal is to get these graphs even. And you can see there's a gap there with the green, the dark green is how much Social Security is getting me toward being able to pay for my expenses in retirement. And the light green is my pension. So I need a little bit more in this scenario. You might run your numbers and you might find them even, and you might not have to save additional. Okay. And now you might want to save additional because then you can, really max out your savings. But in this case, I have a gap. So what I'm going to do is I'm going to go back up to the calculator and I'm going to see what happens if I do save part of my income. I'm going to save $400 annually, which represents 0.6% of my income. And let's see if that helps me close the gap. Very slightly. Okay, let's see what happens if I increase it a lot and I save $6,000 of my annual income. Let me recalculate it. Okay, well, I overshot it. I don't need to save that much. So let me go back up here. I'll go down to 4,000, see what happens. Pretty close. This one is a little bit shorter than what I need, so I'm going to increase it. Let's see what happens if I do 4,400. And there we go. They're about even. So that means that in order to get pointed in the trajectory of 80% income replacement, this calculator is suggesting that I should save $4,400 of my annual income for retirement in this scenario. So I'll just do that for between the ages of 30 and 62, assuming that I'm going to make 6% interest on that. Now, that might sound like a lot, $44,400. But let's see what happens if I divide that up over 26 pay periods. Well, that's only $169. Okay, so that feels like a lot less. And when you're doing the retirement savings, what it feels like is actually kind of important. Gene will go into detail on this about you designate some of your money to the 457B plan. You can start off with $20, and what you'll find is that you won't miss it. Like maybe you'll miss it the first paycheck, but after that it'll just kind of disappear from your mind, and then you can kind of crank it up. So maybe you can't save an additional $169 out of each paycheck to start off with in this example, but maybe you can do 40. Well, you just start off with 40. And then once you find that you're not missing that additional amount, maybe you find you can crank it up $20, here and there. And so the bottom line here is to not get you to save an exact amount and know exactly what your income is going to be in retirement. These are all estimates. This is the future, and the future is, somewhat unpredictable, but it does follow trends, and there is some math involved to make accurate predictions. And so the Acera benefit estimator makes an accurate prediction, the Social Security estimator, and then these calculators will help you get pointed in the direction of the income replacement amount that you're targeting, whether it's 70, 80, 90, 100%. You just get pointed in a direction is all I'm suggesting. Save 20, 40, 60, whatever it is. Or if you can save what the calculator is telling you to save, you can go ahead and do that, and you get pointed in that direction. And then you come back a year later, do the calculator again. It might point you in a slightly different direction. It might tell you to save a little bit more, or it might tell you to save a little bit less. And then you can readjust your savings at that time. Or if whenever you started out, you couldn't quite save what you were saving, but a year later you find you can crank it up a little bit, you get more pointed in the direction. Just, do the calculator again, let it fill in the gap for you. And then you'll find over the years, by the time you reach your retirement, you will have achieved the income replacement target that you were targeting, or somewhere close. And it'll feel a lot less stressful if you just kind of crank it up gradually over time. Okay, so I will just touch on the last few slides very briefly because I really need to turn it over to Gene to talk about the 457B plan. He will tell you about putting your money where you have the potential to earn interest, because by doing that, you can earn more and more through the power of compound interest over long periods of time. And so I'll let him tell you more about that. But if you look at a compound interest graph, it like the longer you leave your money in the market over long periods of time, you're in interest on interest on interest, and it all builds up. And that's why compound interest graphs look like a curve like that. Regarding where you're keeping this additional savings, okay, it's up to you to determine your appetite for financial risk, because what people will tell you is, in general, the more potential for greater interest, the more financial risk. This, really has to do with a lot of short-term investments. If you look at the history of the market over time, over the last 20, 30, 40, 50, 60, 100 years, it will fluctuate in the short term, but the general trend is for it to go up. So it's of low to moderate risk to leave your money in a diversified set of investments over long periods of time. And you can do that in the 457B plan very easily. And I'll let Gene tell you all about that. So I'll skip over this because he'll talk about that. We do have some more information out on our website on that planning for retirement page. If you do max out your 457B account, that would be amazing. And if you want to save your money in some additional lower risk places, there's a lot of information out on that page about, different options. The internet is your friend here, especially websites like NerdWallet and Investopedia will help you find very typical places to invest your money that carry, low to moderate risk. So do your own research on that stuff. And there is some more information on that planning to retire page about index funds and robo advisors and stuff like that. So check out that page. That's acera.org/planning. Okay, so what I'm going to do at this point, besides tell you that if you have additional questions, you can feel free to call us at any time during business hours, 9 a.m. to 3 p.m. At 510-628-3000. I'm going to turn it over to Gene Hilliard, who is our representative from the county's deferred compensation program. Are you there, Gene?
I am here, Mike. How are you?
I'm doing really well. How are you?
Good. Outstanding job as usual.
Thank you. Thanks for joining us today.
Absolutely. Amazing presentation.
Thanks.
All right, let me share my screen. Let's see, share beginning. And then I will switch this over. How's that look, Mike?
We're seeing your notes.
You are. That's not good. Let me over here. How about now? Still
Perfect.
See my notes?
Nope, looks good.
Okay, perfect.
Right,
perfect.
Take it away.
All right, let's go ahead and get started. Well, good morning, folks. My name is Gene Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company in Oakland. We take care of financial planning for clients. We do taxes for our clients. We also do accounting for small businesses. Before I dive into the presentation, I've been meaning to do this for a while. Mike Farah, your presenter here with Acera, does an outstanding job. You won't believe how much information he has to give to you guys and make it palatable and make it somewhat entertaining. I've sat through quite a few presentations from different counties, and you either have a person who presents well but doesn't know the information, or you have a person that really knows the information but doesn't present well. So he does an excellent job of melding the two together, and I would personally appreciate it. Hey, give a shout out to his boss. Let him know he did an excellent job. So I just been meaning to do this for a while. So I wanted to make sure to take care of that. So if you thought he did an excellent job, give him a shout out to his boss. I'm sure he'll appreciate it. I know I would.
That is so kind of you, Gene. Thank you so much. I really appreciate that.
Oh, my pleasure. My pleasure. All right. So I somewhat digressed. A little bit about my background. I'm a licensed financial consultant. I'm a licensed stockbroker. I've been doing this for 20 plus years, helping my clients create wealth and also maintaining their wealth throughout their lifetime, the lifetime of their children and grandchildren. I'm also a retirement counselor. And my goal as a retirement counselor is to help each and every one of you maintain your current lifestyle in retirement. What exactly does that mean? Well, Mike talked about it earlier. My goal is to help you the exact same paycheck that you're getting today. I want you to get that same paycheck in retirement, right? If we have to settle for less, so be it, but more is better, right? Let's see if we can get to 100%. Many of you on this call are probably tier 4 employees. So your pension is probably not going to be as lucrative as if you were a tier 1 or tier 2. So that's where it's extremely vital for you to participate in deferred comp, okay? And I'm going to talk a little bit about that right now. So this presentation, I'm going to probably try to cut it to 30 minutes. Some of it's a little redundant. You went through with Mike, so we should be able to get through this for roughly the next 30 minutes or 25 minutes, okay? All right, so the other thing that I want to make sure folks are aware of, April of 2022, transaction closed where Prudential sold their retirement business to Empower. Okay, so you're no longer working with Prudential per se. You're now working with Empower. Empower is an award-winning company. They do an excellent job of taking care of plans, retirement plans such as yours. So you're in excellent hands. Okay, just wanted to make sure folks were aware of that. Now, you may see some Prudential information here and there because everything hasn't been transitioned over 100% yet, but we're getting there. And so stay tuned. Make sure you keep your email, your address, phone numbers up to date so we can share important information regarding that transition from Prudential to Empower. So what's our goal? I'm a contractor of the county and a subcontractor of Empower. So together, our goal is to help you replace your current income in retirement. And we're just here to give you the tools, give you the recommendations necessary for you to make that happen. I want all of you on this call to I know you may be quite a few years away from retirement, but it's important to envision what retirement is going to look like. What are you going to be doing? In my experience, I have some participants who say, you know what, Gene, when I retire, I'm going to move back to the Philippines to live out the rest of my life. Or I want to travel the world, see different continents. Or maybe I want to see every Major League Baseball park. Or maybe I want to buy a new car every 3 years because I've been driving this bucket that's 30 years old and I want that new car smell. So you want to get a feel for what does retirement look like? And once you've determined what the retirement looks like, I can help you turn that into dollars. How much does it take to help you get there? All right. Remember earlier I talked about my goal is to help you to get to 100% of your salary. But as Mike mentioned, in many cases, you don't need 100%. Right? You need roughly 70 to 80, 90% of your salary. So some people ask me, well, why not 100%? What am I missing? Well, think about the costs that will go away in retirement. Number one, there's a big chunk of your check that goes to ACERA to pay for your pension. That goes away in retirement. Number two, if you're the type of person that contributes to deferred comp and you put a significant amount of money into deferred comp, that goes away. Number three, you no longer have to pay into Social Security. You're done because you're retired, right? So there's a lot of costs that go away in retirement. So you don't need 100%, but hey, more is better. Let's shoot for 100% if we can. See, there's a note. Can Gene's slides be shared with us? Absolutely. They're actually posted on the ACERA site. But if you need that information, email me at g_Hilliard, HILLIARD, at emergefinancial.com. I'll forward that information over to you.
Actually, Gene, I was just going to mention that the version that's out on our website, it could be old. It looks like you may have updated since then. So maybe could you email it to me after and I'll repost it today?
I completely forgot about that. You're absolutely right. I will do that. Thanks, Mike.
Sounds good. Thanks.
Mm-hmm. All right. So where does this 70, 80, 100% of your salary come from? As Mike mentioned, part of it's going to come from your Social Security. You know where to go to find out what roughly your Social Security is going to look like, ssa.gov. Part of it's going to come from your pension, from ACERA. So log on to acera.org, create a user ID and password, use the calculator to get a feel for what your pension is going to look like. You're going to have some income that comes from your assets. Maybe you have positive cash flow on some investment property. You're going to have some earnings. Maybe you come back as a retired annuitant. I don't know. Maybe you're working part-time somewhere to keep yourself busy, which I would encourage. Okay. I would encourage doing something part-time while you're retired, but don't do it because you have to. Do it because you want to. I have failed as the financial advisor of the county. If any one of you has to go back to work, possibly working at a greeter at Walmart, I have failed you by not stressing the importance of deferred comp. So, but if you want to work just to get out of the house, keep busy, that's all well and good. Okay. But these are where your income is going to come from a variety of different places. Now let's talk about deferred comp. It's easy. I'm sure many of you on the call are in deferred comp. You don't have to worry about, all right, I'm going to pay my bills, and then if there's some money left over, I'm going to write a check to Gene and have Gene put it in my deferred comp. It's not how it works, because 9 times out of 10, you're probably not going to have any money left over after you get paid in your mind. We take it from you right out of your paycheck, just like a SARA, just like taxes. We pull that money from you and we pop it into your deferred comp. Okay, so it's easy. So when you don't see it, you don't miss it, and you end up not spending it. So that's a good thing in terms of saving towards your retirement. When you're investing in deferred comp, there's a couple of buckets or a couple of ways in which you can invest your money from a tax perspective. Many moons ago, you only had one option, and that was investing pre-tax. So I'll talk about the pre-tax option. This is where you put money into deferred comp, it reduces your taxable income, and you save in taxes. That's a beautiful thing. So if by chance you get a refund every year, a tax refund, it's tax time right about now, so I'm sure many of you are thinking about taxes. So if you put money into deferred comp pre-tax and you normally get a tax refund, guess what? It's quite possible that your refund will increase because you're showing a lot less in income. Right? Or if you're one of the unfortunate few that always ends up owing, well, you can, in fact, reduce your tax bill by putting money into deferred comp pre-tax, right? Now, I don't know your personal situation. What I'm suggesting or sharing may not apply to you. So check with your CPA, check with your tax advisor to confirm. But there is a very good chance that it'll reduce your tax bill and possibly give you an even higher refund by investing the money pre-tax. Now, remember, you're deferring your taxes today. You will have to pay taxes on this money in the future. But there is also a very good chance that you're bringing in less money in retirement. So therefore, it's reasonable to assume that if you're bringing in less money, you may find yourself in a lower tax bracket in the future. That's a possibility, right? So just keep that in mind. You don't avoid paying taxes. The whole idea here is to figure out how to pay the least amount of taxes as possible, okay? But I'm sure there's many of you that say, you know what, Gene, as a country, we're running up debt as far as the eye could see. Seems like regardless of what political parties in office, we tend to take out more and more and more debt. And at some point, there's going to be a day of reckoning and we need to pay off this debt. And the government's going to raise taxes on everyone, despite the fact that maybe I'm making less money. So you want to get the taxes out of the way today. Well, there's an option called the Roth version of deferred comp. It's not a Roth IRA, it's a Roth 457B that allows you to put money away, you pay the taxes, but you potentially will avoid paying taxes in the future, provided that you qualify. So you pay the taxes today, the growth of your money would be tax-free to you, provided that you're at least 59 and a half and the account has been open for at least 5 years, okay? You can do both. You can do a little bit of pre-tax, a little bit of Roth, but you cannot exceed the max. And I'm going to talk about the max in a minute. You cannot exceed the max between the two. Okay. There are a couple of questions I want to see if I can address. Could you discuss tax deferred options? My income will be high. And I think I addressed that, but with an IRA, for example, if your income's too high, you can't deduct it. That doesn't really apply to deferred comp. Doesn't matter what your income is, you can, you'll be able to participate. Please share your email address. I will do that in a moment. Let's see, is there a cap on a Roth IRA? Remember, this is not a Roth IRA. This is a Roth 457B. And I'm going to talk about the caps in a moment. Okay, let's see. Here we go. The maximum that you can put into deferred comp, whether it be the Roth, whether it be the before tax or pre-tax or a combination of the two, is $22,500 if you're under 50. That's $22,500 is the max in a calendar year, or at least for 2023. If you feel as though you're behind the 8 ball, you haven't saved enough towards retirement, the IRS will allow you to put away an additional $7,500, bringing a total of the maximum contributions for someone 50 and over to $30,000. So that's a big chunk. Okay, so that's an option. Now, there are some of you that maybe need to save even more towards deferred comp. Well, there is something that's called the 3-year special catch-up. That will allow you to put away, what is it, $45,000 a year. Okay, so you can put even more money into deferred comp, and you can do that for 3 years. The soonest you can participate in that 3-year catch-up is 54 and a half. So if you're 54 and a half, you can take advantage of that 3-year catch-up, but you have to qualify. How do you qualify, Gene? Well, the first thing you want to do is you want to send an email to Darnell Williams. Darnell, darnell.williams@acgov.org. Send it to Darnell. Let him know, hey, Gene was talking about this special catch-up. I'm interested. Do I qualify? And he'll run the numbers to see if you qualify. The process is this, pretty simple. He's going to look back through your career to see if there were opportunities for you to put money into deferred comp and didn't. For example, many of you, when you first started with a county, you're probably making very little money and you're not participating in deferred comp. There is money you could have put in. So he's going to go through your career to see if there were some years, year by year by year, to determine if there were some years you can put money away, okay, to qualify. I'd say 90%, 95% of folks who want to know if they qualify will qualify. There's a small sliver of folks that will not qualify. How could you possibly not qualify? Well, look, there are some people, there are some colleagues that you have that are probably sitting in the desk next to you that have been maxing out deferred comp from the first day that they started with deferred comp with Alameda County. Those folks won't be able to participate because they've used up all the room they had to invest in deferred comp. Now, there are few and far between. I'm still trying to figure out how in the world they could possibly do that. But you have some colleagues out there that are, in fact, have maxed out since day one. So just wanted to share that information. I see there's a question up here. Please share. Let me type in my email address real quick. It's g_Hilliard@emergefinancial.com. So I'm sending that out right now. All right. Here's a slide I really like. Here's a person who I had a conversation with who's 25 years old. They say, Gene, what do I need to do? How much should I save towards retirement? I told them you should put away $300 a month. $300 a month. This person said they want to retire at age 65. So in 40 years, assuming a very conservative rate of return of 6%, you're looking at a balance of $575,000. Pretty significant amount of money. That will in fact change your retirement. But this next person, they were a little hard-headed. They weren't convinced. By the way, they had a lot of student loan debt. They weren't making a ton of money with the county. It is what it is. They've gotten a few promotions. They've gotten the religion. They now want to participate in deferred comp. They're 35 years old. Okay. Because they're a little bit older, it's going to cost them a little bit more because they need to figure out how to make up for lost time. This person, I encourage $500 a month. They still want to retire at age 65. You're looking at $490,000 in 30 years. Still a pretty significant amount of money. Or maybe you're just starting with the county at 45 and you want to save towards retirement. It's going to cost you. So I'm encouraging this person to put $1,000 a month into deferred comp. They're going to retire in 20 years at age 65. You're looking at $455,000. Okay, so the point of this slide is this. Obviously here we want you to start as soon as possible, right? $575,000 beginning at age 25 really sounds good, but at 45, you can still make up for lost time, still create a significant amount of cash by the time you're 65, okay? Some of you have probably come from a different county because I've noticed folks that work in government, they move around looking for opportunities to make money. So maybe you came from Napa County, San Francisco, San Joaquin, Contra Costa. A lot of folks are moving from Contra Costa into Alameda County, okay? And you have deferred comp, or maybe you've worked for a for-profit company that has a 401k that's maybe not earning a whole heck of a lot. Consider rolling that money over to Alameda County's deferred comp plan. Consider it, right? Do your homework and I can help you make a determination whether or not it makes sense to roll money over into Alameda County. But by doing so, you know, it simplifies your life a little bit, right? And it's nice to have just one account to have to deal with, but let's be smart about it. Let's do our homework and determine whether or not it truly makes sense. Because, hey, what's the big deal? If you leave it in multiple places, it's fine, right? You just have to make sure and remember that you have the money over there, okay? All right, so let's say...
There was a question up there, or I guess it's more of a comment.
Okay.
They're saying I'm 48 with 17 years vested. Seems like the amount would be too expensive.
I'm assuming this person, Antonio, you're talking about the amount to contribute to deferred comp would be expensive. Mike, do you think that's... Oh, yes. Okay.
Yeah.
Here's Antonio, your situation may be completely different, right? I'm just offering suggestions through this presentation, but your personal situation might be different. So I would encourage, reach out to me first. Let's have a conversation about retirement planning for you and to see exactly how much you need to contribute. So that's a personal thing. Let's talk, okay? So let's fast forward the clock. You're retired from the county. What are my distribution options? Well, the first thing I want to make sure everyone is aware, you don't have to be a certain age to start pulling your money like other plans. Doesn't matter. So if you've saved towards retirement and you're 48 years old, like Antonio, and he wants to retire now, and you have money in deferred comp, you can start spending your money without a penalty. 403B, 401k, if you start spending your retirement money before you're 59 and a half, not only are you taxed, but you're also penalized. Deferred comp is completely different. Deferred comp is under tax code 457B. Rules are different. You can start spending your money at any age. So I just want to make sure you're clear on that, but you have to separate service. You have to leave the county. So you have this pool of money, you can leave it in deferred comp, no harm, no foul. You can still visit with me, but you need to start withdrawing, at least right now. You need to take a minimum required distribution, or RMD is also what this is called, required minimum distribution at age 73. Okay, you have to start taking out a little. How much is that? It's roughly 4%. Okay, I talked about there's no penalty on withdrawing. So you can roll the money also to an IRA if you choose to. You don't have to, but if you choose to, but make sure you're thoughtful and you're thinking through whether or not it truly makes sense to roll your money into an IRA. Okay. Let's see.
Looks
There's
like there's
a
a couple of questions up
couple of
there.
questions. Yeah, let's see.
Now there's 3 questions. What is the projected 6 to 7% return based on? I've been contributing to deferred comp since 2018, but the net return to date is about 4%. Oh, negative
Okay.
4%.
Negative 4%. Let's have a conversation about your rate of return to confirm that. That does seem a little unusual since 2018 because we had some pretty significant big years since 18. So I want to pull up the hood on that one. But the 6 to 7% rate of return is based upon the entire track record of the stock market dating back to 1926. And if you take the average since then, it's actually a little bit higher. It's really closer to about 8 or 9%, but I like to project a little lower. So again, to answer your question, that's really based upon performance of the account dating back to 1926. Are there any fees? Yes, each of these mutual funds are going to have an expense ratio. Okay, there is an expense ratio. That's the amount of money that a portfolio manager is going to charge to manage the accounts. You have some that charge 0.01% through State Street, so very little, all the way up to some actively managed funds that are paying closer to 1%. So depending on which mutual fund you choose, you may be paying 0.01, you may be paying 1 or somewhere in between. On top of that, you're also paying 1/5 of 1% for the ability to even participate into deferred comp. It's 0.20%, very, very, very little to participate. So it's again, 0.20% that is charged. And then in addition to that, whatever the expense ratio that is charged for each of the mutual funds in your account. Okay, so hopefully that question was answered. Let's see, I've maxed out deferred comp for the last few years, 750, didn't realize the cap increased. Can you put more in? Absolutely. So if you're under 50, what you can do is just take 22,500, divide by the number of pay periods that are remaining. We've already been through a few. Typically, if you were starting in January, just take 22.5 divided by 26, and that's the amount that you can put in there. Now, I would encourage, instead of using an amount, use a percent of your salary instead. A percent of your salary instead. Why? Because when you get a raise, right, it will automatically increase your contribution into deferred comp if you use a percent. If you use a dollar amount, you have to remember to go in and increase it. And this is new. You probably, back when you first started with accounting, there wasn't, you couldn't use a percentage. So you had to use a dollar amount, but the rules have changed. So if you need some help calculating what percent of your salary equates to the max, let me know. Okay, what's the latest age you can open an account? As long as you're an employee, I don't care how old you are. If you're 70, if you're 80 years old, if you're still working for the county and you're getting a paycheck, you can participate in deferred comp. Let's see, now that we're using Empower, do you need to set up a new account? You do not need to set up a new account. So use the exact same user ID and password you're using for the Prudential site. Nothing's going to change there. Stay tuned, something could change, but for now, use your user ID and password that you've been using for Prudential. Where do I find the forms to change our elections? If you're talking about, when you say elections, do you mean the amount of money that you're putting in, or are you talking about switching the mutual funds? Oh, the amount of money. Go to, go to AlamidaCountyDCP.com. Go to that website, then click on, there's towards the middle of the page, there's a button that says increase your contribution. It's asking a question. Click on that and follow the instructions. Okay, so that's AlamidaCountyDCP.com. Click on increase your contributions and then follow the instructions. Okay, hopefully that answers that questions. And I went through the flexible distribution options, so we're good to go there. let's see. Taking a loan out. I'm always reluctant to talk about loans, but I'm going to talk about it anyway. Why not? A lot of talk these days about income inequality, right? Seems like the rich getting richer and richer and richer, poor and middle class, it seems like we're running in quicksand and we're not moving anywhere, right? Deferred comp is actually a tool that will help you build wealth so you can potentially catch up. How is that? Well, for example, this is just an example. 2008, we had a crisis. People were losing their homes. It was a tough time in my business. People were struggling, losing their jobs, etc. But you're an Alameda County employee. There were a lot of folks that their job was pretty secure. People, again, were losing their homes. You were actually able to buy a house 50 cents on the dollar, which is unheard of in our lifetime. A house that was worth $500,000 in 2007 was worth $250 in 2008. Wouldn't it have been nice to be able to take advantage of those opportunities? Well, guess what? A lot of folks with Alameda County borrowed against deferred comp to buy their first home, borrowed against deferred comp to buy investment property, right? So there is an opportunity. Now, guess what that house is worth now? You can just imagine. They bought it for $250 back in 2008. Fast forward the clock, how much is that same house worth? That's how you build wealth. So there is an opportunity there, okay? But, you know, there's some folks that say you got in a little trouble with credit cards. You're paying 25 plus. Interest rates are rising on credit cards right now. Guess what? You can borrow. You promise not to use those cards again, right? You can borrow against deferred comp to pay off that credit card debt. Guess how much interest you're saving over time? Think about it. You're saving a ton of interest if you can pay those cards off. Student loans, people are borrowing against deferred comp to pay down some student loans. Well, they haven't been doing that recently because the government has allowed folks to suspend interest payments or interest on student loans. So, but there was a time where folks were paying interest on their student loans and they wanted to pay down that debt. You can borrow against deferred comp, but I need you to be responsible. There are a lot of folks that are borrowing against deferred comp just because they can, or they're borrowing for things they don't need. This money is important. This is your future. Retirement will be here. Trust me, before you know it. And you want to be prepared. So be responsible, but just know that your money's not completely locked up. If you need it, you always have the ability to borrow against deferred comp. Okay. All right, let's talk about investing. Some of you are experts at what you do for a living, right? You're not an expert in the stock market. Well, guess what? There's a great tool that's available to you in deferred comp called GoalMaker. It's an award-winning asset allocation tool where you tell us what your investor style is. I'm conservative, or I'm moderate, or I'm an aggressive investor. You tell us when you anticipate retiring, and we'll do the rest, right? It offers rebalancing. It also offers age adjustment. I'll talk about that in a moment. Here's an example of a portfolio of a moderate investor. It has some stable values, some fixed income, some large cap stocks, small cap, international investments, etc. So we will create a portfolio that makes sense for you. How much can you borrow from? There's a question that popped up before I move on. How much can you borrow? You can borrow 50% or $50,000, whichever is less. 50% or $50,000, whichever is less. You pay that back through payroll deductions, because I know that question is coming next. And you're borrowing money from yourself and paying yourself back. Okay, so hopefully that answers that question. So we're talking about GoalMaker. Here's an asset allocation tool here. Here's an investment portfolio of a moderate investor. So we will do that for you. Once we've created that portfolio for you, we offer rebalancing. What exactly is that? So let's say hypothetically, we created a portfolio for you that consists of 80% stocks, stock funds, 20% bonds, cash, 80-20. And say this For example, the stock market went crazy. Now the stock portion is kind of overtaking your portfolio. And you now, the next 6 months, you look at your portfolio and it's like, oh, it's 90-10 because the stock portion did so well. So you have 90% of your money in stocks, 10% in cash and bonds. Rebalancing will get you back to what you originally had intended in terms of risk. We recommended that you should have 80% of your money in risky investments. You now have 90. We want to get you back to that 80-20. So that's what rebalancing is. It's a great tool that takes the emotion out of investing, and it does something on a consistent basis. It makes sure that you're selling high and you're buying low on a quarterly or an annual basis. That's how you build wealth over the long term. It also offers age adjustments. So you get the asset allocation put in your portfolio, you get rebalancing, and you get age adjustment. What does that mean? As you get closer and closer to retirement, the account gets more and more conservative. And that's a good thing. Okay. The account gets more and more conservative. So once you're 16 plus out from retirement, the portfolio is going to stay pretty consistent. But once you're inside of 15 years, what happens is we move some money out of risky investments and we put some money in more conservative investments because you're going to need the money short term, or you're going to need the money soon. So that's the whole purpose of age adjustment. We want to move your money to more conservative investments as you near retirement, also when you get into retirement, to make sure, because you don't have time on your side to recoup any of those losses. There's a question about socially responsible investments, and we're going to get to that. Okay. All right. Matter of fact, we're going to get to it right now. So we just talked about a person who needs some help. We're going to just use GoalMaker for that person. But maybe you have the time and experience to create your own portfolio. And that's fine too. These are self-directed accounts. You have control over your destiny in terms of how you want to invest the money. So there's roughly 15 different investments in deferred comp. So to answer that one person's question about socially responsible investments, yes, there is one investment in deferred comp that's considered a socially responsible fund. Now, depends on how you define socially responsible. Right? There are some funds that call themselves socially responsible and they don't invest in alcohol, tobacco, firearms. That's it. But maybe what's important to you is climate, or maybe what's important to you is diversity on their boards. So you have to really lift up the hood to see exactly what's available in socially responsible funds. But I will tell you, there is a fund that's available to you in that category. Or maybe you're the type of person that appreciates index funds because they're inexpensive, right? Like a Vanguard, for example, where there's index funds in deferred comp that are similar to Vanguard. They're not Vanguard, but they're similar. The expense ratio in these funds are 0.01. They're through the State Street family of funds, okay? Or maybe you're the type of person, Gene, all this risk stuff makes me nervous. I don't want to see my money go down in value ever. What do you have for me? Well, there's Alameda County Stable Value Fund. No risk investment, pays roughly 2%. That's available to you. Okay. But if you're looking to just create a diversified portfolio of small companies, medium-sized companies, large companies, international investments, etc., we have those types of investments in deferred comp. So you can create a portfolio by yourself. What's next? Nothing else really next to do but to sign up. Here's the website. Go to AlamidaCountyDCP.com. Click on Enroll in the Plan. Don't click on Register. Click on Enroll in the Plan. So once you've clicked on Enroll in the Plan, we're going to need your employee ID number. I think it's your name, your email address. Then an email will be sent to you. Click on that link, answer those questions. But I will say, once you start this process of signing up, don't stop, because it's going to take you 6 months to a year to remember to go back in to finish your job, right? Don't stop. complete that process. Where people get a little tripped up, at least in my experience, is beneficiary information. We need to know who's going to inherit this money if something were to unexpectedly happen to you. And maybe you don't have social security numbers handy. Don't worry about it. Put the person's name, put the relationship, put in their address and phone number, and let's keep it moving. We can get socials later. It's not that important, at least not right now. Okay. The other thing where people get a little tripped up is on the investments. Gene, I'm not an expert at these investments. I think I want to have a conversation with you first, or I want to have a conversation with my financial advisor first. Don't do that. Just choose Goalmaker with age adjustment, just for now, just to get the ball rolling. Choose Goalmaker with age adjustment, put in a percent of your salary, put in a dollar amount if you choose. And then let's keep it moving. The other area where people get tripped up is whether you should do the Roth or do the before tax. Just do the before tax for now, and then we can have a conversation later. Why do I say it's okay to just do it now? Because it takes a whole month before your first contribution takes place. So if you need to make a change, there's time to make a change. We have a whole month, but I just want to make sure you get signed up as soon as possible. Okay. Here's the website that you need to go to. I talked about that. You can also access your account online through whatever this mobile app is. I think it's the Empower mobile app, or through Amazon Alexa for you young folk that want to always use your phone. Okay, not a problem. So you can log online to view your accounts. There are 3, if I might say so myself, fantastic financial advisors that are here to help you navigate this whole retirement planning process. You have Mark Tomei on the far left. You have Jason Brummett, and I said this yesterday, I need to change his company name. He's with Empower now, not Prudential. And then you have myself in the middle. So to reach us, you can call this 855 number, 855-969-4572. Hit option 3, and then choose whichever financial advisor you want to speak with. You can also bypass this 800 number and just call my office directly, again at 510-562-6355. That's 510-562-6355. You can also shoot me an email at G_Hilliard, G_Hilliard, HILLIARD, at emergefinancial.com. So when you do call my office, make sure you tell my assistant that you're an Alameda County employee. Very important. Why? That's code word for VIP. So you're a very important person in my life, in my book of business. So you're going to get the first available appointment. Okay, so call my office. You can also log online to schedule an appointment, whether it be virtual or whether it be a phone. Now, if you want an in-person, the treasurer's office has decided that they're ready to open things up. So let me know where you're located, and we will find a location that makes sense for you, that's convenient for you. Okay. And I think that's the end of my presentation. Hopefully you guys got some valuable information. Please don't hesitate to reach out to me to help you through this retirement planning process. It'll be my pleasure and my honor. So with that, I'll send it back to Mike.
Thank you so much, Gene. That was amazing.
Oh, thank you.